Good morning, everyone, and welcome to the Basics of Business Entity Taxation online training. This is the first of 3 live sessions. To earn CPE for this online training course, you need to pass the exam, which can be found in your course materials. There will be no polling words or questions given during the live sessions. Please feel free to ask questions using the Q&A feature on the Zoom control panel. Today's slides and ebook are available by selecting resources from the Zoom control panel. Today's instructor is Edna. Edna is a tax content contributor at NATP. Welcome, Edna, and I will turn it over to you.
Hi, everyone. How are you? Let's get started today, and thank you for joining us. Unfortunately, it seems like we're having a few technical difficulties this morning, so let's get everything started for you, and we will begin. Today's Basics of Business Entity is 4 hours long, so I thank you for spending some time with me today. We're going to start off talking just quickly. I know this slide wasn't working for you, but for today's information, we're going to take an exam after you've met 70%. You'll get a certificate, and you'll get that sent to you by email. So if you have any issues with that, we've got our education department that will be happy to help you. During today's session, please feel free to ask any questions if you have or need any assistance. We've got some great experts today who will be on the webinar with us as well, helping take care of those for you. You've got your documents and your book available for you. You'll see those listed on our Q&A there so that you can upload those if you need to open those throughout the session. And we'll be covering 4 different items today, so I want to take some time to just cover the objectives for you. First and foremost, we're going to summarize a few basic bookkeeping procedures. I know that for most of you, you may have already done this, but it'll take some time to give us an opportunity to look at taxable and non-taxable income today, some deductible and non-deductible expenses, and we'll also learn how to differentiate between capital assets and expendable repairs. And as well, today we're going to cover some information on depreciation. So we're going to summarize the differences between makers, Section 179, and bonus depreciation, and talk about some of the planning methods of that for your clients as well. We're also going to compare and contrast the various entity structures at the end of our day and talk about some of the tax effects of forming a partnership, an S corporation, and a C corporation. And then as you continue through today and the next 2 sessions next week, we're also going to learn how to prepare a basic partnership, S corp, and C corp tax return. So 4 areas that we're covering. Like I said, we've got a lot of information to do today, but through that, we're also going to take some breaks as we can go through each section. So bookkeeping is first on the agenda. So let's get started. Before we prepare any books for our clients, we're going to look at how they're going to set up their accounting. I apologize. So we're going to set up their accounting first, and we really want to make sure that the company chooses an accounting method that works best for them, that accurately reflects what their income is and their expenses. And we want to make sure that they are consistently using that accounting method. So we can't make that choice for our clients. We want to make sure that they choose something that works best for them. But we've got to make sure that when they select it, it's done when the return is first started, and that they continue to maintain that same set of rules throughout the use and life of their business. If they need to make any changes, they're going to have to ask the IRS for approval. And you'll get some information on that in publication 538. So if you're not familiar with that, that's a great place to look for regulations and instructions on the accounting periods and methods for our clients. The methods that are most available and most commonly used are the cash method. And as you see here, there's 4 listed: the cash, accrual, hybrid, and special methods. Now, we're not going to spend any time today really on hybrid or special methods because the most common really are the cash and accrual. So we're going to take a few minutes to really talk about how those are used and how our clients can help make some of those decisions when they're choosing which accounting method. So the cash method is the most simplest, and it's the most widely used. Taxpayers who have inventory can use the cash method even if they have, if they meet the small business test. So but they're going to look at when that income is reported or received. And in the book, it talks a little bit more about the constructively received income. But for most of our taxpayers, they're going to be calendar-based taxpayers who are using the cash method to list any income they actually receive. So they receive their check and they cash that right away and use that. If they're receiving payments by credit cards, you'll get some information on this as well in the book when you take a moment to read through it. But those expenses are deducted when they're paid. So if you've got a credit card, you want to look at whether or not it's a store credit card or whether it's a widely used Visa or MasterCard. It has the logo on the front of the card. So we want to make sure that if it is a store credit card, that we're not counting that expense until the card is actually paid. So it's deductible again when you make the payment on the store card. But if it's paid with a credit card that has a Visa or MasterCard logo, then that income is received and reported at that point in time. So that cash basis for our clients tends to be the most common and the easiest to use. So when we're working with our clients, we may not always be the one that's taking care of their books for them, but it's important for us to learn these bookkeeping skills and these bookkeeping methods so that when we receive those books from our clients, we understand what they've given us. Because without a good set of books, without a good set of information on income and expenses, we're not going to be able to prepare their return properly. So again, making sure that that accounting method is carried through and that we're actually looking at all of the income and expenses that they have. So just one quick mention on the constructive receipt and expenses as well. We're going to talk about that first. Again, this information is listed in your book, and they've got some really good examples about constructively received. But the money is credited and it's available, and when it's made available without restrictions, excuse me, it's constructively received. So here's an example for you. ABC's company bank credited and made available interest to its bank account on December 31st. Even if your client hasn't seen that money go into their account, even if they haven't withdrawn that money or used it yet, it is considered constructively received, and they must include it in their gross income for that calendar year. So again, even if it's the last day of the year, they want to make sure that they include that interest that they've received as income. Okay. And then one note on prepaid expenses. If your client wants to prepay some of their items, like for example, prepaying their rent, we've got to look at the 12-month rule. The 12-month rule is an exception that allows for the prepaid expense to be deducted when the expense is paid, if the right or the benefit doesn't extend beyond the earlier of 12 months after the benefit begins, or the end of the tax year after the year that payment was made. So for some of our clients, they may have received some income, they've got a variable access to that income, and they want to prepay their rent or prepay their storage fees, for example, if they've got a storage unit. But we want to make sure that that money is in that 12-month rule. So here's an example for you next. For example, on December 1 of year one, the company paid a $24,000 insurance premium with a term from February 1, year 2 to January 31st, year 3. Now, in this case, the benefit extends beyond the end of the tax year and follows into the tax year that the payment was made. The company has to capitalize and amortize the $24,000 over the policy term. They can't take that full amount in year 1, year 2, or year 3. But if the 12-month policy term begins on December 1, year 1, then the payment is made and goes to November 30th, year 2. The 12-month rule now applies. And because the right or benefit is attributable to the payment, and it does not extend more than 12 months beyond December 1, when the benefit begins, payment has been made and can be expensed in this particular case. So remember, it's important that any advance payment that's not meeting the 12-month rule is capitalized and deducted in the year that the benefit applies. So ask those questions with your clients, look at their books and see if there's anything there that may be a prepaid expense that you need to determine whether it fits the 12-month rule or if it needs to be capitalized. In some cases, the entities might be excluded from being able to use the cash method. For example, a C Corp with an average annual gross receipt for the preceding 3 years that exceed 31 million. And 31 million is important. We're going to talk about that a little bit later on. But partnerships with C Corp partners that average an annual gross receipt for the preceding 3 years that exceed 31 million might be excluded from using the cash method. Tax shelters, syndicates can't use the cash method. There is an exception, excuse me, for small business taxpayers. And we'll talk about that here next as well. So even if the taxpayer wants to use the cash method for accounting, please make sure that you've checked to see whether or not one of these exclusion applies to their business. For small businesses, if their average gross receipts do not exceed 31 million for the 3 preceding years, then they may be able to use the small business taxpayer exemption. Basically, if a business other than a tax shelter has annual gross receipts for the 3 preceding tax years that do not exceed 31 million, which is the number for 2025, by the way, then they would be eligible to use the cash method of accounting. You're going to look at the calculation and add the 3 gross receipts for the 3 preceding years and divide it by 3 to see whether or not it can use that. So, and if they're not in business for the 3 years, then you use the time that they are actually in business. So here's an example for you of gross receipts. Water LLC, a limited liability company, has gross receipts at the end of the 3 preceding years for a total of 26 million, 33 million, and 28 million, which equal 87 million. Their average annual gross receipts that apply for the current year are 29 million. So we're going to take the amount or sum of those 3 past years and divide them by 3. Water can use the cash method for all its trades or businesses because its annual average gross receipts are less than 31 million. If they were over 31 million, they would not be able to use that exception at all. So hopefully that clears that up for you, but there are some more examples in the book for you as well. So next we're going to talk about the accrual method. Now the accrual method is the second most common method for accounting periods. So as we mentioned, cash was first, most common, most simplest, but the accrual method might actually be something that we have to do with our clients. So we want to look at their accounts receivable and their payable accounts as well. We want to look to determine whether it matches the income and expenses in the current year. We want to make sure that their income reported when earned may not necessarily have been received yet, but when it's earned and it's reported, expenses deducted are capitalized when they're incurred, but not necessarily when they're paid. So in this particular case, when your client hands you their books, you're going to see that they have an accounts receivable and an accounts payable on their books. So you want to check those records to make sure that you understand the income and expenses they've given you and whether or not they've been received. So let's talk a little bit about the income. We've got to determine when that income is considered earned and received. So in this particular case, we're going to look at what's called their events and what's looked at their income exclusion. So we're going to look at all the events that have occurred, fixing the taxpayer's right to receive the income. So when they received it? Are we able to determine with reasonable accuracy when they've gotten that income? And we want to look at entities with AFSs, which is applicable financial statements. Lots of acronyms in this, so there's a good terminology list for you in the back of the book. But entities with an AFS include amounts in income no later than when the item is reported in their AFS. So we want to make sure that that balance happens. And that's the most important thing with bookkeeping, is making sure that their journal entries match. So we'll find that as we begin to look through the documents that they've given us, whether or not they've recorded that accurately for you. So say, for example, you have a client who you need to bill for their tax return. You've done preparing it, now you need to let them know how much they owe you. But if you're an accrual taxpayer, you're going to report that income then at that point, not when you're paid for the return later. If you wanted to wait to report it when you actually receive the payment, then you would be considered cash basis. So again, we want to look at when you're actually recording the income as received, whether or not you've received it yet, to determine whether you are a cash or an accrual method client. And again, once our client starts with that method, they need to stay with that method unless they ask the IRS to change that. So in this particular case, if we're going to bill them right away and report that income, then we're going to have an accounts receivable, and an accounts payable account. So let's look at determining when those expenses are incurred now. They're not always deducted or capitalized, they are deducted and capitalized in the year that they incurred, but it may not have been when they were actually paid in the accrual method. So basically, we're going to deduct or capitalize expenses when the all events test is met, which means that the taxpayer is liable for the debt and that the liability can be determined with reasonable accuracy. So we've told them how much they owe us that amount, we've reported it as income, but we also need to look now at the expense of that. So it's going to cause an accounts payable journal entry for us. So we want to look also at when the economic performance or when the work was done, when was it occurred. So in this case, for property or services provided to the business as they are provided or used by the business. And then for property or services provided by the business, that they are also provided by the business as well, in case as they are provided. So look at when the work was done, when you're listing it in your journal entry as an accounts receivable, making that expense as an account payable, so that the all events test is met and that our client can reasonably determine when that liability occurred. All right, so here's a quick example for you of looking at economic performance. A calendar-based taxpayer buys office supplies in December, and most of our small businesses, most of our taxpayers actually use the calendar year method. So we'll find that to be pretty common, just like the cash or accrual in this case. The supplies and the bill are received in December, but they pay the bill in January. So in this particular case, the expense can be deducted in the year purchased because all the events have occurred to fix the liability. The amount of the liability can be determined, and we can determine that the economics performance happened in December. So we've got a clear chain of action of when it occurred, when it was billed, when it was received. Even if it's not being paid until January, we know that it occurred in December, and so it must count for that year. So this is the basic accrual method. And there will be, in this particular case, as we mentioned before, an accounts payable on the books for the amount due, even though it's going to be later paid in January in this particular case. Now, one of the other things that we find with our clients is that they might have advanced payments. So in this particular case, we want to look at a couple of different things. Generally, advanced payments are for goods or services, like, for example, a farmer who may buy their seed in advance for the next crop year, or they're for other items that are reported perhaps as income in the year that they're received. Now, accrual-based taxpayers can elect to defer reporting the income until the following year, but not more than that. Again, remember, we talked about the 12-month rule in some cases. So to be eligible for any deferrals, the advanced payments must be must have a full inclusion in the gross income in the year of receipt, and it's under the permissible method of accounting. We've got to make sure that a portion of the advanced payment is included in revenue for the subsequent tax year. And if there aren't any books or there aren't any AFS, then you can earn a portion of the payment in the subsequent tax year. So we've got to make sure that we've asked our clients this, whether or not they're keeping books, whether they're using any kind of method to track their payments. So taxpayers who receive the advanced payment for goods or services or other such items are able to identify that. We want to make sure that that advanced payment is easily identifiable, and they can actually defer it, as we mentioned in this. They've got to meet these three points. So in the election year, to defer that advanced payment, they've got to make that first payment, that first amount, and then all the subsequent tax years, unless they decide to revoke the election. So they've got to consent to revoke the election and treat the advanced payment differently in the future. So if they decided to change that, as we mentioned earlier, you've got to let the IRS know, and you'll use a form 3115 to let them know of any change in accounting methods. So for our clients, make sure that we check those books, see if there's any advanced payments that have been made, and whether or not they've made that election for deferral. And if not, we want to help them fill out that form 3115 to make any changes in their accounting method. So here's an example for you. For our cash basis clients, on December 15th of year one, the calendar year, the cash basis taxpayer receives a $10,000 payment for services that will be provided during year 2. The cash basis taxpayer reports the $10,000 in income on year 1. Easy peasy. We see this happen all the time. Our clients received a nice check, they completed their services, they sent that invoice out, and it was paid right away. They're a cash basis taxpayer that can show that $10,000 in year 1 and report it. For our accrual basis clients, on December 15th, same time frame, year 1, they've received that $10,000 payment for services, but it's going to be provided in year 2. So they got an advance payment. That accrual basis taxpayer can report the $10,000 in year 2 when the services are actually provided. So they may have it in their hand before the end of the year of year 1, but the work itself hasn't been provided yet. So this may be for someone that you provided an estimate, for example, or they've prepaid that work because they've got it available, and now you're not going to report it as income until the following year when the services are actually provided. Now, moving forward to inventory, we see sometimes that our clients may have some inventory that they've got to report. And even though some cash clients may have inventory, we're going to generally see the accrual method with our clients who have any kind of inventory. So if they keep that inventory, there is an exception for the small business taxpayers that will define with an average of 31 million or less. We talked about that a little bit before, that they've got to be under 31 million in the past 3 years in order to receive that exception. So in this particular case, we're generally going to use the accrual method. We're going to choose to account for the inventory as non-incidental materials and supplies, or we're going to choose a method that conforms to the business's own financial accounting treatment for the inventories. So again, making sure that we follow the decisions the clients have made and make sure that they're being accurately reported on their books. So we're going to look again for that $31 million if they've had it in the last 3 years. And if so, then perhaps they're going to have that exception. So here's some more information on non-incidental materials and supplies. So looking at inventory, our clients use all kinds of things for inventory, but we're going to look to see whether or not those payments are for inventoriable items that are deducted in the year that they are first used or consumed. So all those different things that we use to make that final product, we're going to make sure that they're capitalized and expensed when consumed. And then the only change that's possible is if the taxpayer does not have inventory and can use the cash basis instead of being required to use the accrual basis. So in this particular case, all of these materials and supplies help them make that finished product, right? It allows them to deduct the amounts that are paid to acquire or produce that item in the year which they're first used. So we want to make sure that we're looking at what type of items they have in inventory, if they're being used, if they're going to have to be capitalized and held on their books. So here's an example for you of non-incidental materials. Corporation Z, an S Corp, meets the small business taxpayer exception and chooses to use the cash method of accounting. Z accounts for his items as non-incidental materials and supplies and enters into a contract with the homeowner in December of year 1 to replace their roof. Z purchases the roofing shingles and has them delivered to the residence, and he pays the supplier $5,000 upon their delivery later that month. But Z doesn't perform the services until January of year 2, and then gives a bill of $15,000 to the homeowner at that time. He receives a check from the homeowner in March of year 2. All right, so again, he's entered into a contract to replace a roof. Happens a lot. I'm from Florida. Unfortunately, there's quite a few roofs here that are repaired. Almost every day I see someone with a roof getting repaired. And you'll see that delivery of shingles that comes into their home as they're getting ready to begin that roof repair. So everything is brought to the home to stage. And like this case, Z pays the supplier in advance for those shingles, and he's having them delivered to the house. But it's not until January that they're actually being performed. And so in this case, the shingles are that non-incidental material and supply, what they need to produce that final product. The cost is deductible in the year that Z uses and consumes the shingles. or actually pays for the singles, whichever is later. But he doesn't use them until the year that they were received, in this case, year 2. So he's going to deduct the cost only in year 2, the year that they were used, even though he paid for the shingles in year 1. They're sitting in the lawn for a month because of a break perhaps, or perhaps the homeowner's not available, and the only time that they can come to do the repair is in January or year 2. So Z's got to report that $15,000 of income and $5,000 of deductions on its year 2 tax form 1120S. I will be preparing one of those later for you, as well as in the case study that we're going to be doing over the next couple of days. But again, in this case, even though he had them delivered in year 1, they weren't consumed and used until year 2. So because he's using an accrual method of accounting, he's going to report that income and the deductions in year 2. All right, so here's just a summary of cash and accrual methods. Again, cash is when income is received and when the expenses are paid. Most of our clients are going to be using the cash method. It's the most simplest, but we may also have clients who use the accrual method. So we want to look at when their income is earned and when the expenses are incurred for the accrual method. So we want to make sure that we match the income and expenses more accurately under the accrual method. And neither way is right or wrong. We just want to look at whatever is best for our client and continue with that. So most people understand that when I receive the income, it's reported. When I pay it, I deduct it. Very simple. For others, the accrual method is the most appropriate method. Now, here's a list of terms. You'll find these in your book as well. However, we want to be comfortable and aware of what these terms are, especially if we're going to be doing our clients' books, or if they hand us that flash drive with all the documents that we've asked for. We need to be able to make sure we understand what they're giving us. So assets and liabilities, we've talked a little bit about those already. Capital or equity, we have some clients who put cash into their businesses. They're holding cash to purchase their inventory. We want to look at their revenue and their expenses so that we're able to determine what their gross income is, what their expenses are. We want to look at that balance sheet, and we're going to have a few examples of those later on, but the balance sheet is going to show us those journal entries. It's going to show us those debits and credits. We're going to look at the income statement and the cash flow statement to determine whether or not those expenses and income have been reported correctly. We're also going to look at a chart of their accounts and make sure that the income that's put into their chart are correct. Make sure that those items that need to be debited, like expenses, are being sent to the right accounts. And then we're going to look at a trial basis. All of these different items are going to help us prepare the best tax return possible for our client. So speaking of journal entries, make sure that you understand that our debits are always on the left side and our credits are on the right side. It's a natural account balance, and we want to make sure that everything balances on both sides. Otherwise, that might give us an incorrect income or expense amount to take care of our client's tax return. So remember this acronym, ALOR: assets, liabilities, owner's equity and capital, revenue, and expenses. So again, remember that the journal entries, you're going to always have a two-sided or a debit and credit side, and that they must always equal. Okay, so debits would be an asset or an expense, and credits would be liabilities, the owner's capital, or revenue and income. So make sure that those match on both sides for you. Moving forward, here's an example for you of a journal entry. The ABC Corporation buys a copy machine on account for $5,000. The copy machine is considered an asset, and it now increases the asset account. We've purchased something that's usable, but it has a value of $5,000, so we're making it an asset. The payable associated with the copy machine increases a liability. We spent $5,000. We've taken $5,000 to purchase an asset. So we're going to increase the asset side, and we're going to debit the asset account. To increase the liability account, we're going to credit the liability account. So in most cases, when you look at journal entries, you'll see them offset like this. Again, you're going to have a left side and a right side. So the copy machine is $5,000 on the left, and the accounts payable is $5,000 on the right. Continuing the same example, ABC Corp now has some funds and they want to pay off that account. So they're going to use cash to pay off that $5,000. So they're going to decrease the liability because they no longer have to owe that $5,000. And they're going to decrease another asset, which is cash, that cash that they're using to pay for the copy machine. So they decrease the liability with a credit balance, as you see here, and you have to debit the liability side. And then to decrease the asset with a debit balance, you must then credit that asset. So this is the core concept of making journal entries. Now, most of the time, your accounting software is going to do this for you. Hopefully, you have clients that are working with that and are doing that regularly. If not, you may have to help them balance those books when they come in to see you. Some tax offices won't work with clients unless they are also preparing the books for them. And that helps to make sure that those books stay evenly balanced and to ensure that it does require for you to understand what's happening on both sides of that statement. So again, remember that the debit and credit columns are staggered. They're opposite, left and right. You'll see there. The debit is usually listed first and then followed by the credit. This is a great way to remember that everything must stay balanced. Your assets are going to equal your liabilities plus your equity and capital. So this formula will help you determine whether or not those balance looks right. You can take a quick glance at the journal entries and be able to see if they've been entered in correctly. Again, your software is going to do this for you in most cases, but if not, make sure you have a clear understanding of what it is that your client is presenting to you so that you can get the tax return done correctly. One more note about assets. Again, let's look a little bit at what assets are. They're a future benefit. Might be cash, might be accounts receivable, notes receivable, inventory, supplies, equipment, buildings, items that have value, right? So your debit balance or your left side we talked about, they're current if they're used within a year or less, or they may be considered long-term like other assets. So for example, if you have a building, then that building is going to be a long-term asset. If it's copy paper or a copy machine in this case, it may last more than 1 year and it's going to be long-term as well. If it's less than 1 year, it would be considered a current asset. Now, next we want to talk a little bit more about contra accounts. And these are used to offset or to reduce the balance of other related accounts. It helps to balance, in other words. So it's a valuation allowance account. It's opposite from the original account. It helps to reduce the cost to give an adjusted basis to your asset or your liability. Here's a few examples. You might see accumulated depreciation, which is in your credit balance. So that's the contra account for the asset, meaning the debit depreciation expense minus the credit accumulated depreciation. So this is what's moving forward through your journal entries and your statement throughout the year as you're balancing those. And then with the goal that at the end of the year that is completely balanced. So it's an allowance that allows for uncollected receivables, like for that outstanding invoice that hasn't been paid yet. So you'll see the contra account for accounts receivable. These are the solution for this, is to debit the uncollectible receivables minus the credit allowance for the uncollected receivables. So again, we want to make sure that we always have a balance. Remember that formula moving forward, that we're going to make sure that both sides match so that we don't have any discrepancies later that we have to deal with. So that's a contra account, basically a temporary account again. And there's some more examples of that for you within the book as well. Now moving forward with liabilities, we're going to talk a little bit about how those stem from purchases or from borrowing money. They're from accounts payable, notes payables, for example, bonds payable, dividends, unearned revenue, etc. So this is, again, a credit balance. It's current if it's used within 1 year or less, or long-term if it's any other liability. Here's an example for you of that journal entry. ABC purchased equipment for $250,000 with a $50,000 down payment. And now they've got a loan of $200,000, which is payable over 5 years. And the monthly loan payment is $3,500. Now, it is okay for cash basis taxpayers to have loans, like with a bank, or in this particular case, something similar. But this type of loan only impacts their interest expense, which is reported as paid since they're cash basis taxpayers. In this case, it's an accrual method taxpayer who's a little bit different, and they're just purchasing operating expenses, supplies or repairs that they might be billed for later. That would then create an accounts payable trade line. For example, they purchase items from the same store regularly. So they've got a trade line that they've established with that company, and they're paying that off with regular installment payments. So in this particular example, we'll see that the equipment was purchased for $250,000. So we've got that left side debit. They've already made a payment of $50,000, so that's a credit. And then they've got a loan payable remaining of $200,000. So you'll see that on the right-hand side as a credit. Now their monthly loan payment, there's $2,700 that goes to the principal and $800 that goes to the interest as an expense. So we'll see those on the left side, and the cash is on the right-hand side at $3,500. So pretty straightforward. Moving forward to capital or equity, we want to look at some of these items. So we may have capital with partnerships. There's total investment there. They may have a separate account for each partner. And this is the amount that might be owed to investors. It could also be initial investments plus profits or losses, and it's the credit balance. So we want to understand that capital that our client has. And also, in this case, we want to look at the equity, which we might find with partnerships, par value of stock when it's issued. So we do have clients who issue stock as a form of payment or a type of wage or salary. So we want to look that we understand that on their books. Look for any profit or losses of the business. And then again, the credit balance we'll see as an equity as well. And here's an example for you of capital. The book has got a couple as well, but this one is specifically on partnership capital. So we've got Andy and Brett. They form a partnership. Andy contributes land with a basis and a fair market value of $100,000. Brett contributes $100,000 also, but as cash. So now they've both made an equal contribution of $100,000. Capital for Abe is going to be $100,000. Capital for Brent is $100,000. So they both match. And when they make distributions to the partners capital accounts are then reduced. The AB partnership will make a distribution, in this case of Andy and Brent, of $20,000 each. So we see now that there's a debit of $20,000 for each one of them, and then they use cash to pay out that $40,000. Okay. So again, making sure that we understand where those come from. Here's an example of equity. If the corporation issues 100 shares of common stock with a stated par value of $5 for $50 per share for cash. So in this case, there's that cash of $5,000. The common stock is $500, and then the additional paid in capital is $4,500, right? So we're just looking at how that equity is being spread between our different corporations in this case. All right, so now we've got to talk a little bit about retained earnings. And many of our companies will keep those earnings to help not only keep cash in the account available to purchase other items, but also to make sure that they're able to have funds to use for their operations. So retained earnings can be profits and losses since the creation of the partnership. It may also be credit balance if it's profitable. Again, we've got a running total of our debits and credits, so we should see that there's a natural credit balance there. Or we might have a debit balance if the cumulative losses from the operations are too large. So we're going to see that in our journal entries and look at our books. The retained earnings might also be reduced by dividends that are paid out to the shareholders. I'm going to give you an example of that next. So in this case, a corporation declares a cash dividend of $10 per share, and the corporation only has 100 shares outstanding. So retained earnings is $1,000, dividends payable is $1,000. Again, $10 per share times 100 gives us that 1,000. So when the corporation pays a dividend to its shareholders, the liability is satisfied. So now we've got dividends payable of 1,000 and cash of 1,000. Again, thinking as journal entries, you want to make sure that both sides balance there. So here's an example, and just something to look at when you're trying to determine between the capital and equity layouts. For capital accounts, you might have one partner, two partners, or three partners. If partner one has common stock, partner two might have their additional paid in capital and partner 3 might retain their earnings. So each one of the partners in the businesses that we deal with, we want to make sure we understand how they're receiving their distributions, whether they've got stock, whether they've got retained earnings, whether they've been paid any dividends. Moving right along, something else we'll see in bookkeeping that we might receive from our clients are trial balance and income sheet. So the trial balance is a list of all the accounts used during the year. Again, we want to look at making sure that our debits and our credits equal or net to zero, right? They must do this in order to be naturally balanced. The income statement, or IS, is the income and expenses that go to the tax return. So we want to be able to look at that and make sure that all of the income has been reported and any expenses that they've had for the year. So the lower portion of the trial balance statement that you receive are going to have these income and expense accounts for you to look at. Here's an example of that. For example, the cash listed on this particular statement is $2,800, listed as a debit. We'll see accounts receivable, prepaid insurance. They may have paid the insurance for their cars or their property. They've got supplies that they've purchased, equipment that they purchased, in this case, a computer at $4,000. So now we'll see that there is some depreciation, some common stock, and some additional paid in capital. We see those on the right-hand side under credit. And we also see some revenue. So this particular company has had some sales that have equaled 2,500. So as we receive that, we've credited that to the account. We've got some depreciation expense there of $67. We'll note that it matches what's listed as the accumulated depreciation. So as we've had the computer, it's been depreciated now, and we're keeping that balance running throughout the year until the final statement at the end of the year, if they're a cash basis client, or in this case, perhaps accrual. So we want to make sure it matches. We've got an insurance expense of $100. We've got some supplies of $200. Those are debits as well. And now we see a rent expense of $1,000. So looking at the bottom of our trial balance sheet, we'll see that both balance at $12,567. So what they've put out as debits equals what they've received in credits. So want to make sure that those match. Now, looking at the accounts in that income statement, again, we talked about that being at the lower half. Perhaps it's on another sheet, but you want to look for these accounts to make sure that they match. We've got our revenues there at 2,500. We saw that on our statement. And now we've got those expenses listed as well. Rent expense, operating supplies expense. And so we've got a net income at this point in time of 1,133. So this is the lower half again. We want to make sure that they reflect what's out there. These are temporary accounts here, which means that they are going to be closed and reset to zero at the end of the accounting period. So we're going to look at that next under the closing revenue and expense accounts. So throughout the year, our client has been making purchases, paying off those purchases, receiving revenue. So they've listed those in that trial balance sheet that we're looking at. Now we've received the last statement for the year. We want to look at those and make sure that we close any temporary accounts, or make sure that the income and expense accounts that might be retained, or if they're going to be retained, or if they're going to be given to the partners. So most software programs do this for you, but you want to make sure that you understand what's happening. So make sure you look at debiting the revenue and crediting the expenses to zero so that they balance out. Close those accounts, close the capital accounts, zero out the revenue and expense accounts, and make sure that you don't ever reopen any closed accounts, all right? So that that doesn't cause any issues for you later. Looking at the balance sheet next, we're going to talk a little bit about that balance sheet and how this is basically a statement of the financial position for that business. We want to see where they're at. It's a snapshot in time. It's done at the year end after adjusting all the journal entries to make sure that they balance, completing the income statement. We want to make sure that we prepare it and report it on the tax return annually, and that we're not ignoring it, right? Because unfortunately, sometimes we've got those clients that come in with the shoe boxes, they come in with envelopes, they come in with paper receipts. So if they haven't done those books, then you're going to be in charge of making sure that those balance. But if not, make sure that you understand what you're looking at. So look to see if it's a Schedule K or they need a Schedule B for the S corps and partnerships, to make sure if there's anything else that's required that we'll need at this point. So, and here's just an example of another balance sheet for you. Looking at each of those accounts, making sure that they actually use them for that year, that the computer was purchased that year, began to be used that year, so that we do have that accumulated depreciation, that it's correct. And we'll talk about that a little bit later, whether or not we expense that computer, or whether we'll use it as in this case with depreciation. And we're going to look at anything paid additional in capital and retained earnings, like this statement has of 1,133. So there now we have a total liability in capital of 11,133, which should match those trial balance, which should match the journal entries, which should match the income statement. So again, if you haven't gotten the theme yet, we want to make sure that everything balances on both sides so that we can prepare an accurate tax return for our client. So we may have to, however, unfortunately make adjustments sometimes, but before you do that, again, make sure that you check the accounts so that there's not any errors that you carry forward to that tax return. So adjust the balance sheet and the income statement accounts to make sure they reflect the current balances. Go through the accounts one by one and reconcile the balances. Adjust any loan balances, make sure they've made their payments. Is the principal being reported correctly? Is the interest being paid? Do the bank reconciliations for them. Again, there's a lot of software out there that's available for you, whether you purchase an off-the-shelf software or have your own custom software, or if you require your clients to bring those in for you, make sure that you're able to reconcile both sides of that statement for you. Okay. All right, moving right along. Like I said, bookkeeping is important because we want to make sure we understand what our client is presenting to us and to make sure that it's accurately reflected. We want to make sure that we understand what the client has spent, what they've received, and that they as well have a concept and are able to determine what method is best for them if it's their first year in business. Cash is the most common, and the accrual, like I said, is also common as well. We want to use what's best for the client. Now, in your book, you're going to have some review questions on pages 20 to 22. We're not going to do those for the effort of time, but they're available for you. Review those questions because you'll see some of them on the exam. So we're going to take a break here for about 10 minutes, and then we'll come back right together at 11 o'clock and begin our next section on income and expenses. All right, now that break time is over, I want to cover just a few quick things before we move to our next section of income and expenses. I know that we were having some audio problems when we first started the video, so I just wanted to remind you that there are no polling questions during these sessions and that you will actually have to take an exam and pass it with a 70% or better. You'll find that in the members' My Course materials so that you'll be able to take that exam and look at that. You'll also get your copy of this session and the other sessions, typically within a week's time, maybe even sooner than that, but you'll be able to have that information to review both the slides and the video so that you can get ready to take that exam. So moving on right ahead to income and expenses, we want to look first at our income. So there we go. We've got the right slide for you now. So most of us know what income is. We do some work, we get payment for those services. It's pretty straightforward. You perform your job, and those are services that you're then paid for. We get a check, we might get cash, however that's handled. But these are some of the items that we want to look for when we talk about income with our clients. Payment for services, perhaps they did some bartering for some property, maybe they baked you a great cake and you did their tax return for them. Maybe, not that that would be even, but we'll talk about bartering a little bit later on. You might have some real estate rents, personal property rents, you'll have interest and dividend income, and you may have some cancellation of debt income, and we're going to talk about that as well. But there also might be other sources of income. There is a great list for you in your book so that you can determine what income your client has received. Moving on to bartering. We're going to talk about bartering in the sense that it's really an exchange of property. You're going to do something for your neighbor, they're going to do something for you. You're going to provide a service, they're going to pay you for that service using something other than cash. You want to consider what the fair market value is of that exchange. That's what's considered your taxable income. You have to agree on what the value is between you. That may be over a handshake, that may be an email, that may be just a conversation, but one side is going to report the income and the other person is going to deduct the expense. So for example, if my mechanic repairs my van and I complete his tax return, that's bartering. We've determined a price and we've decided that the price to complete his personal and business return is the same as the cost of repair that I need on my van. That cost of repair is revenue for the tax return. So there are going to be journal entries. There's going to be a debit for the distribution because the repair personally benefited me. So I'm keeping the item, right? And the credit, then we're going to credit the revenue account. So again, talk to your clients as you're doing their tax return. If you don't see that listed in their records, make sure you ask, did you barter for any of your services? So that that then gets counted as income for them. We're going to look also at real estate rent. We may see this happen from time to time. We've got a real estate dealer from the property that's being held and they're paying us rent. You might be a trailer park owner that's providing services, additional services besides just the rent, like a recreational hall, or you're providing a newsletter, you're taking care of the laundry facility, or you're helping their tenants buy and sell trailers. So those are going to be services that might be considered real estate rent that we need to look at. We're going to look at hotels, motels, boarding houses, apartments that might also be providing substantial services, like a maid service. So these are all common types of rental income, but they're going to be taxed as business income instead of rental property rent, which is considered passive because you as the owner or you as the service provider is actively providing these services. You're providing that maid service, you're providing ironing boards, you're providing area activities like that recreational hall or that monthly newsletter. Regular services or normal services that we might see in the cost of running a hotel could be providing the heat and the electricity, cleaning the stairs or the common areas or trash collection. Those are all already included in the price that they're paying in their rent, so it might not be something separate, but you want to look at what services your taxpayers are providing for you and for their services to their clients. Personal property rents, we might see that, and we're going to report that rental income of personal property in their gross receipts. They're going to have to be involved in that activity continuously and regularly. Those are the two things that we want to make sure we understand. In order for that to be considered income, what is the primary purpose, right? And how do we treat that profit or that income that they receive? They might be in the business of renting property, typically like equipments or vehicles, formal wear. Perhaps they're renting the kayaks on their property, or they're renting a golf cart. But all of those items are going to receive some income that we need to report, the gross receipts that we're going to report to the trade or business. So again, look for continuously and regularly when we're putting that together. Another form of income that we want to look at, excuse me, is interest and dividend income. So not typically in the ordinary course of business. They might be providing loans for taxpayers in the business that they're in the business of lending money. They might have some accrued interest because the loan hasn't paid out yet and is uncollectible. Or they might have some unstated interest on some installment notes. So again, these are types of income that our clients might have received and they may not have reported them, and we want to make sure we've checked all their sources of income. So interest and dividend income. And then unfortunately, we will also see sometimes the cancellation of debt. So this could be excludable from their income if they have an exception or exclusion. As mentioned here, a bankruptcy, perhaps they're insolvent. We often see this with our clients who might have received a credit card that was written off. They've got some debt that they need to see whether or not they're insolvent. So if that's the case, you're going to complete the form 982 to do that. And we're going to show you an example shortly. But again, look at the exceptions. Do they qualify for any of that? Is there a purchase price adjustment, which would reduce the basis? And then would the debt have been listed there as a deduction? Okay, so exclusions and exceptions in this particular case. Here's an example for you with the ABC Corporation. They've got a cancellation of debt of $20,000, but they're insolvent up to $10,000. So the only tax attributes in this case are the depreciable asset. They're going to complete that form 982 to show that they're insolvent for that $10,000. You'll see it listed there in part 2. And this is what we would prepare for them and attach to the tax return so that they can see that they were insolvent for a portion of that. And if not, then we know that that cancellation of debt then becomes income that is taxable. Other types of incomes that we might see, we're going to see this, these miscellaneous items, not too regularly, but we might have some damages that they've got to report, some kickbacks that they've received. They've got recovery of an item that was previously deducted. Perhaps they had an item that they wrote off, an invoice that was never paid, and now that person has come back and paid that invoice, so they've got to report the income. They might have a promissory note, and then they've got some lost income payment, for example, under business interruption. So look at these other sources of income for your client and see if there's anything else that we need to list for them as taxable income. On the other side, we're going to talk about their expenses next. So we're going to look at whether or not those expenses are broken down into deductible business expenses, non-deductible personal expenses, whether or not they're fully deductible. We also need to see whether they're not deductible, but they might be capitalized, and whether or not they're part of cost of goods sold to produce that item that our client is making. So make sure that we look to see whether they're expenses that are ordinary and necessary, and that's under Business Section Code 162. So we want to look also at whether or not they're have personal expenses mixed in there. So again, very important that we look at our clients' books and make sure we understand whether or not they're using any of those items for personal use. And if that's the case, then we can't deduct it. So no deduction for personal, living, or family expenses. The expense could potentially be for both, but we need to be able to allocate it between both of them. So we see that a lot of times with vehicles, with computers, with the use of a home. We might have a unit, let's say, for example, a storage unit that's used for the business inventory, but they may also be storing some personal items in there. So we've got to make sure that we're able to allocate those expenses properly, figure out what's personal and what's business. And we're going to talk about that later on through our examples too. Next up, we're going to talk about deductible business expenses. And so these expenses really are the cost of doing business, right? To carry on the trade or the business, we've got to have some expenses potentially that are used to help make that profit. So we might have salaries and wages, right? We've got to pay those workers for actually doing the work that help us get our items sold. We might have repair and maintenance. Perhaps if we have a lawn mowing company, we've got a lawnmower that's broken down and we've got to repair that. Or we are in a food business and we need to have our refrigerators running, so we've got to have that repaired. So we want to look at the repairs and maintenance that they've had done. Are they ordinary and necessary in order to continue that business, right? That it's common and accepted in the industry, and that it's a necessary expense to help get that business up and running. So we may have rent. We may have to rent the place that we have our business at. We've got storage rent. We might have rent on an equipment. And then we've also got to pay taxes, right? We've got state taxes, perhaps there's some sales tax, perhaps there's some city taxes, depending on where you live. But we got to make sure that those are expenses and payments that have to be done in order to get that business running. So, and then any interest, we might have some interest on a loan that we've paid. So ordinary, necessary are the keywords here. Your book does go into some greater detail on pages 28 and 29. It'll cover some more expenses for you there. Talking about salaries and wages up next, we want to look at those expenses and really determine if what's being paid is a reasonable compensation, right? Now, the IRS doesn't necessarily give you the exact dollars that you're going to spend for each salary, but you want to look at what's similar for that business and what they would pay for those services. So examine the circumstances, look at the factors such as the duties that are performed, what's the volume of business that they handle, what's the character and amount of responsibility. We may have someone that helps manage our staff. So that office manager typically will have a salary that's higher than one employee. You may have some business complexities that they're handling. Might be some cost of living adjustments. And you want to look at the ability and achievements of each employee. So while you're not the HR rep or the person determining what the salaries are for each employee, you want to make sure that you help the client understand what actually is salaries and what are wages. So for example, if they give one of their employees $100, is that a $100 bonus? Is it an increase on their wages? Is it a birthday present? Is it something taken out of cash to be able to go buy expense or to buy something that they need for the business? So understanding the salary and wages that are paid. So in that particular case, we may have some that are deductible and some that are not. Once we understand that, we'll be able to determine what's an actual legitimate expense. So look at the history of pay, perhaps. There might be some policies regarding the pay in their employees. So you'll help look at whether it's reasonable compensation. All right, repairs and maintenance, as we mentioned, that's also an expense. So you want to look at amounts that are paid for repairs to their tangible property that might not be deductible elsewhere, so that it's not capitalized or it's not added to the cost of goods sold. It's something that's done as a repair in order for you to continue your business. So, but don't deduct costs that don't improve the unit of the property. So UOP, which you'll see is one of the terms listed in the book, a unit of property, or basically the asset like the building or the lawnmower or the piece of equipment that you're using. So look at deducting costs that don't better restore or adapt that property. And we'll talk about that in just a few minutes, but deduct those costs that maintain the property. For example, you need to put a new door lock on your storage unit, or you need to fix that lawnmower. As we mentioned, you might need to replace something on one of your vehicles, your tow hitch, for example, to tow your storage in the trailer that you have. So make sure that you keep that property in normal, efficient operating condition, right? So to make sure that it's up and running to continue your business. So we're going to talk about betterment, restoration, and adaptation, which are three words that we'll see with some of our assets in another section. So repairs and maintenance, we want to make sure that we understand what our client wants to do, because we can elect to capitalize the cost of repairs under section 1.263. But once they elect that, it is irrevocable, and then they might depreciate as an improvement, depending on what type of repair and maintenance is done. So they have an option to elect to capitalize the repair cost instead of expensing it. So we're going to talk about section 179 a little bit later, but in this particular case, we want to look at whether or not they're carrying a net loss for the year, so that if we capitalize the repair, we can then use that as an expense in the future years as depreciation to help offset any income that they have later. But as I mentioned, that election is irrevocable and you cannot change your mind. So this is an option to consider when the taxpayer has a net operating loss for that year. So again, as I mentioned before, looking at those books, determining whether or not they've got a profit or a loss, that first quick glance may help us to plan what's going to be best for deducting these expenses or capitalizing these expenses. Bad debts is something that we mentioned. This perhaps is worthless credit sales to a customer. We've done the work, we invoiced them, they didn't pay. It might be partially worthless. They've made a down payment, but they haven't been able to finish. So if they're a cash basis business, then they cannot deduct it because that amount was never included in income. But if they're an accrual basis taxpayer or business, then they may be able to deduct the uncollectible amount, which was previously included in income. So Company Z put that roof on for the client. They received a $5,000 down payment, but then they've got $10,000 that hasn't been paid yet. If they were cash basis, they wouldn't be able to do anything, but because they were accrual, they deducted it. They can deduct it as a bad debt because they've already included that $10,000 in income. If later on, Company Z gets that $10,000, they can collect that and use it and list it under ordinary income because they had already included it as income because of their accrual basis. So there's a couple more examples in the book for you as well, but you'll see that that sometimes does happen. So as you notice, bookkeeping methods are really important to make sure that we understand whether or not they've taken a bad debt as income before and whether or not it can be included now as regular income because they've gotten it paid, or whether they're not able to take it at all. Bona fide debt is the next thing for you. So factors to determine whether or not a bona fide debt actually exists is that we've got to make sure that there's evidence. Are there documents? Was there a fixed repayment schedule? Was there interest charged? They have any collateral that we obtained, for example? Did we actually demand repayment? Did we call the client, notify the client by email, by mail? Did we have any payments that were made on the debt? And then is there any transaction recorded in our records? Is there any information, right? Going back to those bookkeeping records, is there something listed? And then what's the financial condition of the debtor or the person who actually owes? So we know that we've got this debt. We want to make sure that it's a valid and enforceable obligation. Make sure that there was some method of payment arranged, that the loan was supposed to have been repaid either with a fixed payment, a schedule in advance. So, and when we do that, that will help us determine whether or not it's truly a debt or not. So for the IRS purposes, they want to make sure that there's actually something that can be followed, that there's some evidence to provide, because they don't give you specific guidance on what a debt is, for example, but we want to make sure that something is traceable, right? At the end of the day, is there something that we can determine whether this debt was actually a legitimate and eligible debt? So we've got to make sure that the debt is completely or partially worthless. We want to find out what the financial condition is of the debtor and the value of the collateral. For example, someone that we may have sold a car to. Now, is that vehicle salvageable? Are we able to repossess that item and try to recoup some of our losses? All right. So if the business will need to prove that they've tried all avenues of repayment and were completely unsuccessful. We contacted them by phone, by text, by email, by letter. We've contacted that next of contact. We've done everything that we can to try to get back that repayment before we actually write it off as a bad debt. So that's the most important thing to do in this particular situation. So they're worthless loans. They can't be paid back. We're not getting any new money, but we're going to deduct it in different ways. All right. So if it's a business loan, you deduct when it's totally or partially worthless. If it's a non-business loan, you're only going to deduct it when it's wholly worthless, which is like short-term capital loss on a form 8949. So this is where we're going to get down to how do we actually let the IRS know that we had this bad debt and that we want to expense it. So the company is going to prove that this loan was worthless. They are going to show that they tried to collect it. They're even going to have some information on whether the debtor has told them that they have funds or don't have funds. So, but there are limitations, of course, if they're cash or accrual, as we just mentioned. All right, moving forward to rent expense. We're going to look at two different methods there. As we mentioned, the cash basis and the accrual method. We want to look at when the rent is paid, and we want to make sure that that rent is reasonable, especially when it's being paid to a related party, like a relative or a related business. So you can deduct that depending on whether the business is cash or accrual basis in these manners. So under the accrual basis, we cannot deduct rent to cash basis related parties until they include it in income. So related parties, we may see that with one person renting to a family member or to a very close friend. We want to make sure that we capitalize the prepaid rent and deduct any amount allocable to each tax year. So again, we saw that earlier. We paid rent in advance. We paid X number of dollars for a couple of years. We want to make sure that we only deduct the amount that's allocable or that's used in the tax year that it applies to. For cash basis taxpayers, we're going to deduct rent in the year that it's paid and capitalize if the prepaid rental period extends beyond the close of the following year. So looking at that 12-month rule again, and then making sure that there's not any valid reasons under a business to not capitalize that. All right. So when one thing I want to say is when we rent to a related party, example, I'm going to give you an example here just so that maybe it clarifies that for you, is with an S Corp owner, if they own the building personally, and then they're wanting to rent that to the business, they're renting it out, the business pays the rent to the owner, then the owner must report that rent on Schedule E under the cash basis. The operating business that pays the rent is accrual. So the operating business, in this case, perhaps falls behind in actually paying the rent for a few months. They cannot accrue the expense and take the deduction until they actually pay the owner. And the owner picks up the rent and places it on their Schedule E as income. So if that business that was operating as accrual falls behind, doesn't make their payment on time, then it becomes a cash basis for this particular item only. So you have the building, you operate your business in the building, your building pays you rent for the use of that personal building. It's cash for the building owner, it's accrual for the business. If the business falls behind, then they now have to pay. This is a cash entity, this cash payment for the rent that they fell behind on until they're caught up. So, all right, so it can be a little tricky, but again, make sure that we understand what the terms are of the rent expense in this case, or what the terms are of the contract that has been made. Here's an example of capitalizing the rent for you, and you'll find a few more in the book as well. But in this particular case, this is the 12-month rule also. So Laura is an accrual method calendar year taxpayer. So in January, she leases a property for 3 years at $6,000 per year. She prepays the full 3 years at $18,000 in January. But since this is a prepaid expense, it has to be capitalized. She can only deduct $6,000 per year, which is correct because she's under that accrual method for the 3 years. So $6,000 for year 1, year 2, year 3, right? So why might they do this? It could be perhaps cash flow. This particular person had a great year. They've got a big bonus. They want to make sure that they've got their rent taken care of. So they've prepaid the rent for 3 years. So this may happen in a scenario where cash flow is a concern, or perhaps they want to avoid a rent rate increase. So they may prepay that. Okay. So we're going to debit the rent expense of $6,000 and credit the prepaid rent $6,000 in this case. And for the 12-month rule, as we mentioned, that cash basis taxpayer can't deduct the prepaid rent in the year paid if the prepayment does not benefit the period beyond the earlier of 12 months after the business realizes the benefit or the end of the year following the year business made prepayment. So here's an example of that, because I know that that can seem a little odd, but basically we've got a situation where in this particular case, Nancy is under the accrual method. She leases a building for the monthly rent of $1,000 beginning in July. On June 30th of year one, she pays an advance rent of $12,000 for the last 6 months of year one and the first 6 months of year two. She had a really good year. Maybe she sells stuff at Comic-Con and she decides that she's got enough money to prepay the rent for the year. So she had a really good sale year. And now she's done that $12,000. So she can only deduct $6,000 in year one for the right to use the property during year one. So the 6 months that she prepaid from July to December is what she's going to deduct. And then that $6,000 that she already paid in advance for year two, she'll deduct in year two. So for your journal entries, you're going to debit the prepaid rent for $6,000 and rent expense for $6,000, and you're going to credit cash $12,000. However, if you have the 12-month rule and we're looking at that, this is a continuation of the example. So Nancy is a cash basis calendar year taxpayer, and she may deduct the entire year of $12,000 in year one. The payment applies to her right to use a property that does not extend beyond that 12 months. So again, remember, in this case, she only paid for 12 months. She didn't pay for 3 years like our other example. But if she deducts that $12,000 in year one, then she cannot deduct any part of that amount in year two. So this can be an issue as far as planning. We want to make sure that that client is able to use that expense, right? If they had a net operating loss, they may not be able to effectively plan for those years if they want to have some expenses for the following year. So she, or I should say in this case, the idea for her is to consistently have 12 months of rent each year as an expense. She's trying to prepay that amount so that she has more of a deduction against her gross income for the year. So when our clients look at whether or not to rent or purchase, we want to look at whether it's going to be a better situation for them. So we want to look at whether they're going to deduct the total annual rent or the lease expense that they paid and incurred for that year. In some cases, the rent payments really are just payments to purchase the property. This could be a rent-to-own contract or a conditional sales contract that someone makes between themselves and the original owner of that item. So it's a purchase option that cannot be deducted as rent. It would have to be a payment that they are making towards the purchase of an item. So it could be a conditional sales contract. So we've learned whether or not the terms are under a sales contract or under a rent-to-own option. So if that's the case, we want to look at what items are listed there. Is a portion of the payments going to the equity, going to purchase the item, like the principal, for example, like we see with a loan? Does the business get the title to the property after making a certain amount of payments? So they've agreed on purchasing that item 6 months from now or 12 months from now after they've paid off that amount that they've been making in payments. So total payments for the short period of time to use a property is basically the amount that would be required to transfer that title. So and the amount that they're paying exceeds what the fair rental value would be. So if it costs $100 to rent that trailer, but your client is paying $300 a month, it exceeds what the fair rental value is. So you may need to determine, is there a sales contract in place there to buy that item after a certain amount of time that they've rented it. So the property must be purchased for a nominal option price in comparison to the fair market value. And we want to make sure that a portion of the payments is designated as interest. So there's a built-in interest rate there into that payment or what we might consider a rent-to-own payment. So for this case, journal entries for the conditional or for the capital lease. If it's a $200,000 asset, your left side would have $200,000. Your note payable would say $200,000. For your monthly payments, let's say they're at $1,000 for the principal, and then the interest is $200. So we're going to make 2 journal entries. We're going to show that the note payable is $1,000 for the principal, and that there's an interest payment of $200, and cash would be your right side entry at $1,200. To incorporate both that principal and interest payment that's being made on the item that they're renting to eventually purchase. All right, moving right along, we're going to talk about taxes. So taxes may come in the form of deductible or non-deductible taxes. So there's a list here for you. For example, you might see real estate taxes and sales tax, of course. We might have that in the employer share of employment taxes or SE taxes. We might have franchise taxes or fuel taxes. occupational taxes, personal property taxes. We're all very familiar with these. Some of the non-deductible sides, of course, we can't deduct federal income tax. We can't withhold, cannot expense or deduct employment taxes that are withheld, excuse me. State or local taxes that are imposed on the buyer. The buyer has to pay a portion, and that is not deductible. And then any state and local taxes that are added to the basis for the assets, right? When we purchase something, we're going to include what we've paid in sales taxes to the basis of that item. So when we have sales tax, typically those are going to be capitalized as part of the asset, as I mentioned. Sometimes sales tax is collected as a liability. However, the business might report sales with the sales tax, and then it could be an expense. We've seen it done both ways. You just need to make sure that you're consistent with your client on whether or not they're listing sales tax as part of the sales or separately. So the idea really is, again, making sure that it balances and that you're able to properly reconcile those forms, because if there's ever an audit, you want to be able to have that paper trail to show that yes, sales tax were paid and deductible, or no, these particular sales taxes were not deductible. Okay, so just make sure that you keep good records, or that your client keeps good records that you can understand in the case of an audit. Interest expenses, we're going to see those as well. This is, of course, interest expenses are the amount charged for the use of the money that the entity borrowed, right? So if the loan was used 100% for business purposes and you're paying interest on that, then that interest that your business paid is 100% deductible. If the proceeds from the loan, however, are used for more than one thing, you may need to allocate that interest between the various uses. For example, you might have non-passive trade or business use. You might have passive trade. You might have investment interest, portfolio interest, or personal interest. That interest expense must also not be deducted to buy any tax-exempt securities, to amortize points there and other prepaid interest over the life of the loan if it's a cash basis method. You may have to capitalize the interest subject to UNICAP. And we may have to impute interest on below market loans if there's no exception. And again, remember not to deduct interest that's accrued to a cash basis related taxpayer until the year the interest is actually included in the income. So, and to that last point, that's the same concept as the rent that we talked about earlier. An accrual taxpayer may not take the deduction for an accrued expense that is to be paid to a related party, but the item then converts to cash for that accrual basis taxpayer. So looking at related taxpayers, again, that could be a family member, or it could be a very close friend, someone that you have some type of related interest in. Okay. All right. Business interest expenses and the limitations for that fall to section 163. That's a limitation on the deduction for business interest. It may be, you might have an exception for that, but if the limit applies, the deduction for the year cannot exceed the following sums: business interest income, 30% of the adjusted taxable income, or floor plan financing interest. So real property trade or businesses can make an irrevocable election out of the limitation as well. Again, we're talking about section 163 for that, and determining whether or not the business is below an average of 31 million for the last 3 years, as under the average of gross receipts. The business interest, again, means any interest that's been paid or accrued on any indebtedness properly allocated to that trade or business. So it does not include investment interest like we talked about earlier. And if you did not get a chance to read the book, floor plan financing interest is really when you acquire, for example, a motor vehicle or an appliance that's held for sale. It's on the showroom floor. You're using that item as collateral. And so the debt is secured by that item, like the car that you're purchasing, and the interest on that may be deductible, but it is under a limit. So if it's a real property trade or business that can make that election, then again, we want to make sure that we do so, but they will have to use the alternative depreciation system, the ADS, to depreciate non-residential real property. We're going to talk about depreciation a little bit later on, but again, just know that if they want to make any changes or they want to make that irrevocable election to get out of the limit, then they need to do that. All right. So accepted businesses. We talked already about being subject to Section 163 and that limitation on the last slide, especially for business interests. But if they're performing services as an employee, or if they're electing out of real property, trade, or business, or they're electing a farming business, or even utility businesses, those could be considered accepted businesses. And they're accepted under Section 1.163. You're going to make that election, and you're going to report the taxpayer's name, their address, their social, or their EIN in this case, if they have one. You're going to describe what their business is, and you're going to include their principal business activity code, and then a statement that that taxpayer is making the election pursuant to Section 163. So we see that sometimes with our farmers. If they're doing a Schedule F, you might have a Schedule C if it's a small business, but regardless, we're going to look at whether or not they are accepted and whether they can elect out of that. All right, so there's an example of that in your book for you too. So other expenses that our businesses are going to have are cost of goods sold. And that cost of goods sold really is a combination of what your beginning inventory was, the purchases that they made during the year, and what that inventory is left at, in order to provide us the cost of goods sold for whatever product or service that we're providing there. So we want to make sure that we account for inventory either using the non-incidental materials and supplies, or any method that conforms to what the taxpayer is using. So again, what they start with, that they continue with. Are we accounting for those items correctly? So for accrual taxpayers, unless they qualify for that exception, again, that $31 million in 3 years, that average, that's our magic number. We want to look at whether or not their cost of goods sold is properly prepared. So we can treat inventory again as non-incidental materials and supplies. You got to keep track of them. All right. Are they being used in the business to make that product? Are they being paid for at the time that they're bought? Or do we need to capitalize those as supplies in the books for them? Okay. Make sure that we're using the right statement for them if they have accounting methods, that it's being written and that it's valued at the end of each year. And a good way to check this is that your inventory starts as the beginning inventory for the next year. So if you've got a new client that's coming to you that you haven't prepared their books for before or looked at them, take a look at what they had last year to see if their beginning and ending inventories match, so that you can see if there's a discrepancy or not. All right. Cost of goods sold also include merchandise that might be for sale or stock and trade. Might include raw materials. So if you're producing fabric items, you might have lots of fabric in your inventory, or you might have some items that are in process, right? You've started making some jackets, you've started making some items, but they're not finished yet. You also have some finished inventory that's on the rack ready to sell. And then you've got some supplies that become part of the item for sale. So you've purchased buttons, or you've purchased hangers, and they're all being used for that inventory to provide that finished product for you. All right. Now, inventory does not include goods that are sold, meaning that the title has passed now to the buyer. They bought that item, they said they want it, they've taken it, or you've taken those goods that you've completed and you've consigned them to a business to sell for you. You might have future delivery. If the taxpayer doesn't have title just yet, they don't have it in their hands, hasn't been sent out, but you've already withdrawn it from your inventory as well, and it's getting ready to be delivered to that person. Or you might have taken inventory out and decided that you don't want to sell it after all, and you're going to keep it for yourself personally. So you might have COD mail items, meaning that you've got some inventory, but it's not being paid, or cash on demand. You don't get it paid for until the buyer actually has the product in their hand. So you might also have scenarios where you've got containers that are including inventory, but the title hasn't passed to the buyer yet. So you want to exclude any containers from inventory that you might have in that scenario. So you've got a bulk item that's going to someone, you've still got it in inventory and the title hasn't passed, but once it passes to whoever that buyer is, that's when you're going to take it out of inventory. So whether or not you see that final list of inventory from your client, you may not, but just have a good discussion with them about what their inventory includes and doesn't include. You want to make sure that they're able to compute the beginning and the ending inventory by identifying and valuing the items. So there's a couple of methods for this, a couple of identification methods, if you will, and the book goes into this a little bit more, but the most common that we see are these two, first in and first out, or what's called FIFO. Last in and first out is another option, but it does create what's called LIFO layers and maybe a little bit more difficult, but there are some examples in the book for that. But generally what that means is it goes into the inventory. First one in is the first one to come out, and in reverse order is last in, it goes in, and then you take it right out of inventory. So make sure that they're valuing the items using either the cost method or lower of cost or market, or any method that's approved by the IRS. So if they do a fair market value or what's called a market price, then you want to make sure they continue to value the items that way. Or cost method would be, what does it actually cost to prepare that one item? And that's the value that you're giving to the item. So you'll see that then next in the 1125A, which is the form used to prepare cost of goods. So we're going to do an example of that. The textbook does go through a line by line item for you, but for these purposes, we're just going to kind of skim through and look at where we would place some of those numbers that our client is going to give us. So beginning inventory in this particular example for Taffy, they're a calendar year S Corp. They make widgets. Taffy uses the cost method to value its ending inventory, and they use FIFO to identify the costs in that inventory. So here's a list of what their current year expenses are. We've got beginning inventory at $456,812. The ending inventory is $203,400. They've purchased raw materials of $765,230. The labor to actually produce their items is $320,650. They've got some additional expenses under section 263A of $35,000, and they've got other costs of $120,000. So this reflects what the cost of goods are that they have. We'll see that their beginning inventory is listed there. We may want to go back and look at their previous year's numbers to make sure that that ending and beginning inventory match. And now we know that with this current year inventory, they had some items go in that they purchased, they used some of those things, and now this is what's left. So we're going to use the form 1125 to report that. You'll see that they've got the inventory listed there, the purchases, the cost of labor, also determine what the cost of goods are sold. So make sure you go through that. And again, our software is going to do a lot of this for us, but as any good tax professionals, we're going to preview those forms to make sure that the numbers make sense, that we've checked off the boxes that we need to check off, to make sure that if there's any change in inventory or in the methods used, that we report that on this form as well, because you'll see the boxes checked off no there, so that we can tell the IRS we haven't done any changes. So, all right. And like I said, there are some more examples in the book for you there of that. So capital expenses, we've got organizational costs, startup costs, business assets, and improvements. And believe it or not, these sometimes get mixed up for our taxpayers. So we want to make sure that we have them understand what these different types of expenses are. So they are going to capitalize certain costs instead of deducting them, but they do then become part of the taxpayer's investment in the business. They're going to be reported on the balance sheet because they become assets of the business. So we have to then determine whether they're going to be depreciated or amortized, which is what we're going to talk about next. But here's an example of organizational expenses. These really are for the creation of the corporation or the partnership. It's not for the day-to-day running of the business, and they're charged to a capital account. If it does not meet the definition of a currently deductible expense, then it would be amortized over the life of the corporation or partnership if they had a fixed life. If they've been incurred before the end of the first year in which they're in business, or if they were incurred by the due date, including extensions for the first year of the tax return, that may be allowable. For a partnership, it's a type of item that normally is expected to benefit the partnership throughout its entire life. So they can include, but are not limited to these items that are listed here. So on the corporation side, we might see incorporation fees, legal fees to draft those articles, the cost of organizational meetings. Now, these are not necessarily meetings that you might go to a resort, Some of those costs are definitely not going to be deductible, but perhaps you meet at a local library or a local event space and you have all of your company officers together to meet, and so you've got some costs included there. You might have temporary directors or consultants that come in to help you set up your corporation, and you have someone to help you set up your books and your records. These are all pretty common organizational costs. On the partnership side, again, you might also have some legal fees. You might have fees to negotiate and prepare the agreements, to file the fees, or other accounting fees to organize the partnership books. So again, organizational costs, you can deduct up to $5,000 in the year that the business begins, but that limit is reduced, but not below zero, to the extent the organizational costs exceed $50,000. So we're going to have an example of this next, but any remainder amount is going to be amortized over 180 months in the year that the business begins. I'm sorry, I went the wrong way. Here we go. All right, here's an example for us. By the book, a calendar year corporation incurred $14,000 of organizational expenses for the year the business began in November of year one. They deduct $5,000 again, because that's the limit, plus $100, and that $100 is for that month of December. That's $9,000, which is the remaining amount between the 14 and the 5, and they're going to divide that by 180 and take that by 2 months, excuse me. So November and December of its organizational expenses for year one. So 5,100. So the remaining 8,900 is going to be deducted at $50 per month over the next 178 months between years 2 and years 16. All right. So again, $50 per month over the remaining 178 months. We've taken $5,000 as a deductible expense that first year, plus $100 for the 2 months that they were operating business. All right. Now, if the corporation using the cash method can amortize the cost, the corporation using the cash method of accounting can amortize the cost in that first year, even if it doesn't pay them in that first year. But a partnership that's using the cash method can deduct the organizational cost only if it's been paid. Again, remember, accrual versus cash is going to be different. So when did they actually make the payment and when was it actually used? So our next is startup costs. So again, we've had organizational costs. Now startup costs are used to actually create the active trader business. So similar idea to organizational costs, except it's a different type of expense. These are used and paid or incurred before the business begins, so that you might have that in order to start the business and get it going. So could be investigating the creation or acquisition of a trader business. It might be activity engaged in profit or production of income before the trader business begins. So let's say you're a cookie baker and this is you making the cookies the day before. So these are startup costs to buy your equipment, to buy the items in order to make that product that you're going to sell on day one. You haven't opened up yet. All right. Startup costs can also include costs paid before it begins, such as the analysis or survey of potential markets or labor supplies, might have advertising, wages to train the employees. You might have some pre-opening repairs or maintenance that needs to be done. You might have rent or utilities for that business space before it opens. So you're paying to rent your space. You've got to do that before you actually move all of your assets, all of your equipment in to start training people. So those startup costs don't include any interest or taxes or research and experimental fees, but these are some of the common costs that we're going to see. All right. The book also has a more comprehensive list for you there too. Much like the organizational costs, you can deduct up to $5,000 in the year the business begins. That limit is reduced, but not below zero, to the extent the startup costs exceed $50,000. And again, whatever's left, you're going to amortize over 180 months in the year that the business begins. So just like organizational costs, but here's an example for you. So if the taxpayer, or one keynote I want to mention before we start that example is that if that taxpayer fails to go into business, those already incurred business expenses fall into one of two categories: costs incurred before making the decision to enter the business are personal and non-deductible. They include any costs incurred in the course of that business search, right? Looking to investigate whether it's a good opportunity or possibility for you. If the costs are incurred in connection with the attempt to occur or acquire or begin a certain business, then they're capital expenditures and are deducted as capital losses. All right, so two categories there. Depends on whether it's searching to make that decision or whether it's in an attempt to acquire that business. So in this case, John incurred $52,000 of startup costs before his car wash opened in November. In year one, he deducts $3,544,000. 5,000 minus 2,000. Now remember, that magic number is 50,000, so he went over it by 2,000. So that's what we've got to deduct from that 5,000. And then we're also going to add $544, which is the difference there and the amount for those 2 months that he was in business, November and December. So 52,000 minus 3,000, which is 49,000 divided by 180 times 2 months. So the remaining amount of 48,456 is deductible over the next 178 months at $272 a month. All right, so $3,000 for that first amount, $544 for the 2 months, gives them a total of $3,544. That is a startup cost expense that he can take in year one. Now, moving right along to business assets, we're going to look at the Uniform Capitalization Rules, which is UNICAP. Businesses have to capitalize the costs in order to acquire or produce real or tangible personal property that's used in their business. So the cost of that building or the machinery or the furniture or the trucks that they're purchasing. So we may have to capitalize certain costs to produce real or tangible personal property held for sale, to acquire that property for resale, to produce real and tangible personal property for use in the business. We may have to capitalize any interest during production. And for inventory, that might be administration costs, taxes, depreciation, insurance, officer compensation, rework labor, and contributions to pensions, stock bonuses, or profit sharing plans. So we're going to capitalize those under the Uniform Capitalization Rules. Now, there are some exceptions, of course, like anything else. We want to look at whether they meet the small business exception and if they don't have to capitalize costs. This could be a good situation or a bad situation, depending on whether or not the client has any income or expects to have larger income in year two, which most businesses do. They tend to have less income the first year as they're starting up, but they're not required to capitalize the costs under those rules. They may have the exception also because they have are subject to UNICAP rules regardless of their gross receipts, which are syndicates or tax shelters. So we won't talk about those here, but there are a couple examples in your books that you might see too. All right, so next up is the de minimis safe harbor. So we talked about whether or not moving forward, whether a client might want to capitalize those costs or whether they have to. But the de minimis amounts that are paid to acquire personal property or tangible business property in this case will need to be deducted on their books in their records if it's treated as an expense in this situation and doesn't exceed more than $2,500 if they don't have an AFS or an accounting financial system, or $5,000 if they have one. So the property must have an economic useful life of 12 months or less. Meaning it's something that after 12 months, it has more life, excuse me. So it's not an item that may last more than 12 months, okay? So look for those numbers. In this particular example, we're going to talk about Ace, who purchased 10 printers at $300 each for a total cost of $3,000. That's what we've seen on the invoice they gave us. So each printer is a UOP or a unit of property. So each one has a cost of $300. They do not use any accounting methods. They don't have an AFS available for us to review. So their accounting procedure that's in place at the beginning of year one says that they want to expense amounts paid for property costing less than $2,500. So for ACE, they're going to treat the amounts paid for the printers as an expense on its books or record. Again, even though the 10 printers total $3,000, each one is only $300, so they're under that de minimis amount of $2,500. And this particular business has said that anything under $2,500, we're going to expense. So they want to expense all $3,000 worth of printers because it meets the requirements for the de minimis safe harbor rule. All right, and continuing that example just a little bit further. So if ACE elects to apply the safe harbor in year one, they may not capitalize the amounts for the 10 printers moving forward. So that's straightforward expense. If they take the expense, they can't also depreciate or capitalize the amount later. So instead, ACE may also deduct these amounts under section 1.162-1 in the taxable year the amounts are paid, provided the amounts otherwise constitute deductible ordinary and necessary expenses. They need those printers in order to conduct ordinary business. It's a necessary expense. They need it in order for their business to continue. So because each printer is under 2,500, they're able to use the de minimis rule and actually expense all $3,000. All right, so when the scenario comes into play that they're going to sell those printers later on, maybe they've used them up and they've decided they're going to buy a bigger printer, but they found someone that wants to buy all 10. Now they're going to sell those printers for maybe $1,000. That $1,000 is now straight ordinary income because they already expensed all 3,000. So we're going to see that happen occasionally with our clients. We just want to make sure we know whether they actually expense them completely or whether they're depreciating those items. So keeping track of their assets on their inventory list is a great way to do that. So we do get a lot of questions sometimes about new windows. So things happen, a window breaks, you may have to replace it. That window costs $1,000. They're not cheap, especially if it's a triple pane. But because each one of those windows that you're replacing is under that $2,500 de minimis safe harbor amount, you might be able to just expense that one window you have to replace. 10 windows that you have to replace. But if you're replacing all the windows in your building, you are now looking at capitalizing the cost of all of those windows, especially if it's 100% business use or 100% of every single window that's been changed in the building. If you're only changing a few windows, for example, maybe only 10%, 20% of the windows in the entire building, and they're under that $2,500 each, then you may expense that. What we've seen as the percentage typically out there that the IRS looks at is at about 30%. So if you're starting to replace more than 30% of the windows, again, 100%, then you're going to capitalize those amounts and depreciate them versus taking the expense. So when we look at the replacement of any kind of major component or a structural part of what your property is, like this window or perhaps a roof that you're replacing completely, under section 1.126, we want to make sure that we determine whether or not it's going to constitute a major component of that building. And because it's a major component or substantial, then we are going to have to capitalize those items. So there's another example in the book for you that talks about this more exclusively as well. So we mentioned that at one point the client would have to make an election and determine whether or not they're going to expense those items under the de minimis safe harbor election. They've got to notify that and provide a statement. It's very simple. It's not anything that's very difficult to do. As you see here, we're going to provide the taxpayer's name, their address, their ITIN number, or their TIN number, excuse me, or their EIN perhaps, and then that they're making this election to use the de minimis safe harbor. All right. All right, moving forward. So for small taxpayers with that safe harbor, we're going to deduct the capital improvements as repairs and maintenance if the business has an average annual gross receipt of 10 million or less for the prior 3 years, or that they own or lease any eligible property that has an unadjusted basis of $1 million or less, that they don't pay the lease for more than 10,000 or 2% of the unadjusted basis of the eligible business property for repairs or maintenance and improvements. And then we're going to attach a statement to a timely filed original income tax return for the costs that are subject to that election. And we're going to list whether or not they've begun to depreciate the improvements in the year that they're placed in service. So we have to capitalize again the cost of making those improvements to the business asset if it results in making the building or the asset better, if we're adapting it or if we're restoring it And we're going to talk about those three things next. But we want to look at whether or not that safe harbor rule for improvements means that they can deduct them at the end of the day. So again, understanding what your client paid, why it was paid. Was it ordinary necessary? Or are we increasing the value of that item? So again, like with the other de minimis rule, we're going to show a small statement that has the taxpayer's information and that they're choosing to make that election by capitalizing the repair and maintenance costs. All right, so we've got review questions on pages 52 and 54. So we want to go through those. I'm not going to do this with you here, but you can certainly look at them through the book. But again, we're looking at income and expenses that our businesses can take. We want to look at what type of income, has it been bartering? Is there a clear defined sales contract if it's something that they're going to buy, and to determine whether it's an expense that we can take or not. Okay, we're going to take a 10-minute break before we get started with our next section, which is fixed assets and depreciation. So if you'll meet me back here at, let's say 10 after, then we can get started on your fixed assets and talk about how we want to depreciate those items. All right, welcome back. Now we're going to talk next at fixed assets and depreciation. So we've looked at basic bookkeeping. We've reviewed the income and expenses for our clients. So now we want to look at what assets they have and whether or not they're going to expense those or depreciate them. So this section is a little bit longer than the other two, but we're going to get started on that right away. So fixed assets are items with a life over 1 year. They're used to generate income. It might be property or equipment or technology, might be reported on the balance sheet as property, plant, and equipment or PP&E, and these are capital assets. So they have a life of more than 1 year, and they're used to generate that income that our client is reporting. So we're going to look at whether or not they'll be able to depreciate them. They're expensed. They're not expensed, excuse me. They're not expenses, they're purchased. They're capitalized and depreciated, or they're amortized over their useful life. So they lose value over time and use, but that eligible property must be owned, can't be leased or rented, has to be used in the trade or business. The life has to be determinable over 1 year, and it's subject to wear and tear. So the other property that we need to look at, of course, is what may not be eligible for depreciation. So it's been placed in service and disposed of in the same year. We looked at that in some of our examples, has less than a useful life of 12 months. Land is not eligible for depreciation. Any intangible assets that we have are going to be subject to amortization. Natural resources are going to be subject to depletion. And so we may see this as well, but not quite as often. Their inventory or stock and trade is not going to be eligible for depreciation either. And this is equipment that the taxpayer is going to use to build their business asset. But the depreciation has to be capitalized to the basis of the asset, not expensed. All right, so we're going to do some examples for you as well. But some of the elements of depreciation is that we need to know is the basis of the asset, right? So we have to calculate what the cost is when it was placed in service, what recovery system or cost recovery system is makers. That's typically the most common that we'll see. We need to determine the asset class, the method of depreciation, and the convention, or how long is it useful for? How are we going to depreciate it? And what methods are we going to use? So we're going to go through those. And now most of this we don't have to do by hand. We've got software that can do all of this for us, but we need to know these elements or these pieces of the puzzle, if you will, so that we can make sure we depreciate the item correctly over the life. Now, if you have a client that's new and it's coming to you, like I mentioned before, you want to see their books, but you also want to see their asset list. You want to determine whether the items they've been depreciating in the past are done correctly and being able to carry over that same method when you take over their tax return for them. So for their basis itself, which is the cost of the item, we need to look at what you've paid for it, right? Which can be the sales tax, could be freight and shipping to have it sent to you, the installation charges to actually get that equipment up and running, any transfer fees or title fees. We see those more common or often with vehicles, trailers that we might purchase, other acquisition costs in order to get that item and make that ours, right? Transfer the title to us. So these costs are something that are very normal and common. Freight and shipping, you may have to include that. Not everything is free Amazon Prime shipping, but if you've got an item that you have to pay to ship, then you're going to include that in your basis. Now, I mentioned on the last slide, the placed in service date. We want to know when that item was placed for use in the business. If it's a new business, after it starts, or perhaps if it's idle property that's sitting there but needs to be repaired, so it's still in service, it's still depreciating, it's just waiting to be used because you've got a repair coming. So, but depreciation stops when you retire or withdraw that machinery or that piece of equipment from business. So, or when it's fully depreciated, you can no longer depreciate it. Even if it's still working and you still got it up and running to make items, if you've already depreciated it completely, then you will not have depreciation to continue. So, in the examples that we've got for you in the book, they talk a little bit more about that placed in service date, but if you're opening the doors for the customer, then that placed in service date is usually the day the doors open. But if you purchase a house to rent, do you look at the day that you purchased the house, the day that you get into the house, the day that you get a renter, or let's say you've got it in service, but it's not able to rent just yet because you haven't found someone to rent it. So all of those different nuances, we've got a couple of examples in the book for you specifically, but we want to look at when to begin to depreciate, and that's going to come from the information that we get from our taxpayer. So in the case of a rental, which is from the text, you'll see that one of the persons purchased a duplex. She wants to rent it out to tenants. She spent a couple months making repairs and improvements, and this is pretty standard. She begins to advertise it for rent on July 19th in this case. The property is ready and available for use. On July 19th, that becomes the day that it's placed in service, not the couple of months that she was fixing up the rental to get it out there and ready to go. So make sure that you understand that with the items that our clients bring to us, especially with rentals, we'll see that. So placed in service date. Looking at the permanently withdrawn from service date, as I mentioned on the last slide, looking at when the life of the property is no longer available. Do we need to scrap it? Do we destroy it? Is it abandoned now? Is it no longer being in use? Did we sell it or exchange it? So that's when we have to stop the depreciation, when it's retired from services, when it's recovered its cost completely through depreciation, whatever comes first. So, and in some cases, as mentioned here on the slide, abandonment or destruction. Maybe you had a building that is no longer serviceable. Maybe you have a lawnmower that you've fixed so many times you can't even count, and it's just not usable anymore. So now you've got to withdraw that from service. You sell it for scrap, or it's already been used completely and you can't depreciate any further. So now that we've known that information about our items, we've got to determine how we're going to depreciate it. So a little history lesson for you here, and you'll see some information in the book. The maker's depreciation, or what's called the modified accelerated cost recovery system, is in use after 1986. There are two methods available, two systems there, the ADS and GDS. All right, and under the alternative depreciation system, you'll see that it's not used quite as much as the GDS. But you want to get any more information on that, definitely look in publication 946. Tables B1 and B2 are going to be where you find information on those depreciation systems and where to find the percentages that you're going to use when you depreciate your items. So looking more in depth at the alternative depreciation system, it does have longer recovery periods than the GDS. But if you elect to use the ADS system, you want to look at these different items. That the listed property that's used is 50% or less in the business. If the tangible property is used predominantly outside of the US, is it tax exempt use property? Is it bond financed? Was it used predominantly in a farming business? And was it in the same year that there was an election not to apply the UNICAP rules to the farming? And then also whether or not the property was imported from a foreign country with an executive order in effect due to trade restrictions or anything that engages in other discriminatory acts, then we may have to look at using the ADS for that type of property. So for business, that's handled a little bit differently for the farming industry. We've got some great webinars out there for that, but the farming industries may decide to use the ADS to depreciate the property with a recovery period of 10 years or more. And so that may help them when they've got years that their income is volatile. So, but the GDS, as I mentioned, is more common. So we're going to take a few minutes to talk about the GDS. It's typically the prescribed system, unless they elect to use the ADS or if it's required. So you're going to select a class after you figure out the basis and placed in service dates. There are 9 property classifications: 3-year, 5-year, 7-year, 10, 15, 20, 25, 27 and a half, and 39. There is another one, a 10th class of 50, but we often don't see that one. So, but there is some information in your book on those. That class life specifically is for all type of improvements resulting from excavations like tunneling or embankments or roads or streams or slopes. So that's typically more long-term type of assets that need 50 years because you're improving, or a railroad track, for example, you might be using that class life. All right, so depreciation methods, once we've determined GDS, then we're going to look at whether or not we're going to do a 200 declining balance or 150 declining balance, or whether we're going to use straight line. So those three methods are available under the GDS. For the ADS, we're going to look at only straight line. All right, so the 200%, you probably have seen this already, but this is typically 3, 5, 7, and 10-year property. And that's the one you're going to run into the most, by the way. So the maker's system switches to maker's straight line if the first year that the straight line depreciation is more than makers. And we're going to have an example of that next, so that makes a little more sense for you. But you might have half year or mid-quarter conventions, and then you're going to recover the cost at twice the maker's straight line rate if you determine to use the 200% declining balance. So this is something you'll have a conversation with your clients to determine whether or not they need more depreciation in the first few years of their assets, meaning perhaps they have more income, and so they want to offset that with depreciation, or perhaps they want to go longer and choose a different declining balance method. So, but under the 200 declining balance method, here's an example for you. So we've got an asset that has a $10,000 cost, and it has a 5-year useful life. We're going to ignore half year and mid-quarter here at this moment. We're going to talk about those later, but very simple, 10,000 divided by 5 years times 200% gives us $4,000. So using the normal half year convention, the deduction is adjusted for only half of the year, which is 6 months. So they have a $2,000 depreciation deduction, which is 20% of the original cost. So 2,000 divided by 10 gives us that $200 declining balance, excuse me. All right, so moving forward in that example, the following 3 years of depreciation would be year 2 at 3,200, and year 3 would be 1,920, and year 4 would be 1,152. Okay, so now looking at the maker's straight line depreciation, if they were to use that method instead of the 200 dB, year 2 would equal 1,778. Year 3 would equal 1,371, and year 4 equals 1,152. So we see there that at year 4, the 200 dB and the maker's straight line are the same at this point. So again, do we need to give the client more depreciation in the beginning years of their business so that they have more of an expense available? Or would we maintain and use straight line instead that would show a more even amount throughout the years? All right, so year 4 is where it gets a little different there. So year 4, they now equal the same for both methods, 200% declining balance and straight line. So in year 4, we switched to straight line, and the remaining 2 years of the asset's life, which is 5 and 6, are computed using the straight line deduction. Again, it's a 5-year property, but we've got 6 months left because remember, we only took a half year at the beginning. So year 6, we take 6 months left, which is 576. So that is the difference now. When you're looking at the 150% declining balance, this is typically on 15 and 20-year property, even including farm property, same concept, except that now you're using 150% instead of 200. So you can switch to, or you will switch to the straight line year when it becomes greater than the 150 dB, but you can elect to use it if it's something that you want to extend the life of your depreciation. You want more, in other words, over the years, a more steady amount, and you want to take it slower. So you choose that election. It's irrevocable. You're going to report that on a 4562. All your property has in the same class is going to be using that 150. So, and then it's can be elected, but by the due date of the return, including extensions. So the third option that we saw was straight line. Straight line is used for 27.5 and 39-year property. It's mid-month convention, which means you start the depreciation on the middle of the month, and you elect to use straight line perhaps on other property as well. If you're going to do that on everything, then you will also make it irrevocable. You're going to report it on a 4562 by the due date of the return. So again, you can elect, or your client can elect to do all of your property under straight line. They will make that irrevocable election. Or perhaps they might use the 200 or the 150. So we've looked at all three methods. It's having that conversation with your client about that depreciation and if they want more expense up front. All right, so the conventions themselves, we've already mentioned mid-month and half year, but we've also got mid-quarter. So these are ways to calculate the amount of depreciation that's taken and when it's taken during the year. So we've picked out 200 dB, 150 dB, we've picked out straight line. Now we have to determine that convention. So we want to look at what the starting point is. And although we've already determined the date, place, and service, the actual starting point for depreciation is one of these three conventions. So we're going to look at each one individually now. For the mid-month convention, or MM, as you see there, this applies to commercial real property, residential real property, railroad grading, and tunnel bores. It also has a recovery period that begins at the midpoint of the month that is placed in service, and then ends at the midpoint of the month, removed from service. So we talked a little bit about railroad grading and tunnel boring being from excavations, excuse me, not evacuations, but excavations that include any type of construction, embankments, clearings. So that was that 50-year class life that we talked about. So you've got some more about that in your book, but that's mid-month, placed in the middle of the service of the month, and then it ends midpoint of the month when it's removed from service. Here's an example of that for you. So on September 2nd, Carrie purchases and places in service a rental home costing $195,000. So mid-month convention means September 15th is the deemed beginning date. And so for the first year, it's 27.5, 12 months in the year, so 330 months of depreciable life. So we take 195,000, which is the cost, divided by that 330 months, and we get depreciation of $591 per month. So we're going to use half of that for September using mid-month convention. And then October to December are full months. So that's 1,773. So 3 months of depreciation at $591. And that's going to give us a total depreciation of $2,069. So that's going to be her depreciation amount for the first year under mid-month convention. All right, half-year convention is basically saying that the property was considered placed in service at the midpoint of the year, regardless of whether they placed it in the first 6 months or the last 6 months. It's a half-year convention. It's also used for the year of disposal. So again, a 5-year property is going to now have a 6-year of depreciation available. It is on tangible property, not on real property. So here's an example for you of that. If we have a doctor or dentist who's purchased a coffee table in his waiting room for $5,000 in January, so again, for 6 months of the year, his furniture and fixtures are considered 7-year class life and are depreciated using the 200 dB. So the manual calculation for that 1-year depreciation is 5,000, which is the cost, divided by 7 years will give us $714 for a full year of depreciation. However, we have to divide that by half because we're using a half-year convention, so 357. And then 357 by 200% is 714. If we were to go under the 150 declining balance, that would be 357 divided by 150. And 714 divided by 2 is 357, which is the half-year straight line depreciation in this case. So there's an example of using all 3 methods for you. You can see that the 200% dB is a much higher depreciation deduction than the 150. And of course, the 150 is higher than the straight line method. So again, this will determine how your client wants to move forward, and they'll continue to use the same depreciation schedule year by year under that. Last but not least, we're going to talk about the mid-quarter convention. So this applies when 40% of the basis of property is placed in the last quarter of the tax year. So your client purchases all of their things in November, or more than 40% in November. They have to use the mid-quarter convention. So except for residential rentals or commercial rentals or that railroad grading and tunnel bores. So you're going to use it for the entire life of the asset, but they've got to meet these 2 items, which are called the test and implementation. So we're going to talk about that next. The mid-quarter convention test, as we mentioned, is over 40% of all assets placed in service in the last 3 months. It excludes non-makers property, property that's been expensed, which that makes sense. If you expense the entire cost of the item, you're not going to also depreciate it. Residential and commercial rental and railroad grading and tunnel, of course. Listed property is included unless it's expensed under 179. Again, we've taken the cost, so there's nothing left to depreciate. Properties placed in service and disposed of in the same year, or personal portion of business property. So you've used a portion of that building or that location or that item, that asset for personal property. So that's not going to be deductible. Okay, so here's an example of that. Perfect Pets Vet Services, they purchase and place in service all of the following assets. So we see we've got assets throughout the year, some in January, some in March, some in July, some at the end of the year. So all of those together combined total $287,600. So in July 8, she bought a building that was worth $200,000. So that was a pretty large item, but altogether $287,600. We've got to determine the quarter of those items. So from January to March, it was $16,600. From April to June, it was $10,000. For July, $9,500. October to December is $27,500. So these are the items that are eligible under makers. So $63,600 divided by 27.5, which is what that last quarter of the year was, is over 43%, 43.24. So we have to use the mid-quarter convention for this item. All right, for all of these items, not including the building. So if we looked at Perfect Pets electing to expense the laptop or take a section 179, we're going to move some items out of those numbers for each quarter. All right, so you can see in October and December, we moved out the cost of that computer, which then lowers our percentage to 38.4. So 38.4% means then that the mid-quarter test is not met, so it does not have to apply the mid-quarter to that. So we can change this number and manipulate it, as you see, by taking items and expensing them under section 179. So, or even bonus depreciation, which we'll talk about in a little bit. But regardless, we want to look at when did our client buy their materials or their assets in this case, when they place those in service, which quarter, to determine whether we have to use mid-quarter or whether we can use mid-month or half year. All right, so implementation is the second half of that determining factor for mid-quarter convention. So we look at the initial year and multiply the full years of depreciation by a percentage and depend on which quarter they placed it in service. So we talked a little bit about this, that first quarter, second quarter, third quarter, or did they place them all in the fourth quarter? So it doesn't matter when they actually placed it in service. We want to look at when, what the total is and what the percentage is to determine what we're going to use to depreciate that. So here's an example. Again, the same vet service on September, they purchased $9,500 worth of landscaping, and it was placed in service in the third quarter. So because that 43.24% of the assets were placed in the final quarter, the landscaping is subject to the mid-quarter convention. So first year of depreciation, that $9,500 divided by 15 years, which is its last life. And if we use the 150 declining balance, that's going to be 950. And if we use the 37.5, because that's the quarter, right, that we look at, we take that 950 of the full year, divide it, or I should say multiply it by 37.5%, and we come out with $356 of depreciation for the year. All right. Now, we may have some clients who are working with short year depreciation, meaning that they've got a tax year less than 12 months. So it's typically the first initial business return or perhaps the final tax return that you had, their final year of business. So you do not use the depreciation tables, but you use the following calculation instead. You want to calculate the makers for the full year and then multiply it by the following fraction, potentially the number of months it was placed in service during the year based on the convention, right? Half year, mid-month, or the mid-quarter, which is 12 divided by 12 months. And then if they use it for the entire life of the asset, that may also make a difference as well. So we've got some more information in the book on that, but just keep in mind that when a client decides to close their business or open their business. If it's a short year, they may have to do some different calculations for the depreciation, and you'll have to help them with that. So for fiscal years, they're the same as calendar year basis in the sense that it's treated the same, and then you may have short-term rules that are going to apply in this scenario. So we got to understand when they open their business, when they close their business, when they purchase items. So the depreciation methods on the short year are similar. We're going to look at the same as full year. We're going to use a half-year convention or a mid-quarter convention, and there are going to be some different types of examples and more information for you available in the book on this. So just be aware that a short year has some different rules. So moving forward, let's talk a little bit about what some of the repairs versus improvement might be on your items. We talked in the last section about expenses and whether or not an item is going to be maintained or repaired to keep it in service and to continue providing the ability to use it, or if you're replacing the items and it's now improving that item, like the windows example. Instead of just repairing one window, you've now replaced all 20 windows in your building. And so this is now a cost that you have to capitalize. Okay, so improvements of that unit of property or that asset that you have might actually raise the bar or raise the value of that item if it falls in either one of these categories: betterment, adaptation, or restoration. So bar is a great way to remember those items. So think of replacing a kitchen in your home after it was damaged. If you upgrade the kitchen, purchase new appliances, buy new countertops, change the layout of your kitchen perhaps, and you've now increased the value of your home by that improvement instead of just replacing it, then it is a cost that you may have to capitalize in this particular scenario. So when we acquire tangible property or produce that tangible property, then we want to make sure we understand the invoice price, the transaction costs, any costs for the work performed prior to the date that it was placed in service, and we're going to capitalize any amounts paid to acquire or produce that asset. We're going to capitalize any costs that we need to defend or perfect the title to real or personal property as well. So what are the fees required for us to get property or ownership of that item, right? So those are the costs included with acquiring that item. And here's an example. Jesse purchased new cash registers for use in his retail store. Each cash register is an asset, much like the printers that we talked about earlier. This cash register, each one is a separate item, okay? So they're not categorized as material or supplies, and he has to capitalize the amounts paid to acquire each cash register, all right? Unless it falls in that de minimis range. Remember, we talked about 2,500 or 5,000, then he could expense them. But for this example purposes, he's not eligible for de minimis range, and we're going to capitalize each asset and depreciate them. All right, so that's acquiring. If we improve a property, meaning that we are going to make it better, right? If we're going to look at those three here next, then we need to capitalize the costs. So under betterment, or the B portion, if you will, then we want to look at these items. Was it a material addition to the asset, such as an enlargement, an expansion, or extension? You added a new office and you attached it to the building you already had. For example, if you have new equipment that's going to increase the capacity or production or efficiency, you've now taken that piece of equipment and you've added something to it, or you've made it better, is what we're looking at. So what's the purpose of the expense? What's the physical nature of the work? And what's the effect on that asset or on the UOP? All right, so taking something better is taking something that's not great and making it better. So here's an example of that. If Chuck purchases a store on land with underground gasoline storage tanks in year 1, all right, the parcel of the land is the asset. The tanks leaked during soil contamination, or causing soil contamination, excuse me. Then Chuck discovers a contamination in his second year, and he incurs costs to remediate that soil, to make it better. He now has tried to remove that leak. He has bettered the land, bettered the asset. So he has to capitalize the cleanup costs because they existed prior to him acquiring the property. But on the other side, cleanup costs that are like this are not necessarily capitalized if it's something that happened in the course of his business, something that could be repaired perhaps, and it doesn't cause it to be an increase in value for that land. It's not a betterment in this particular example. Adaptation is something that we also see happen that we'll need to capitalize. So if we're going to change that item and provide a new or different use for it, or if the use is no longer consistent with when it was placed in service. So we've changed the nature of how we're using that asset. Now we have adapted it to perhaps a new business, or we have changed its use. And so that is something that we will have to capitalize. And here's an example of that. So in this case, Ace is a manufacturer. He owns his own building for manufacturing since it was placed in service. In year 30, he converts the building into a showroom for his business. But to convert the facility, he has to remove and replace some structures, some components to provide a better layout for the showroom and its offices. And then he also repaints the building as part of the conversion. So he's done some things now in year 30 to change the building itself. So the cost to convert the building into a showroom, to adapt it, are going to be eligible, and is not consistent with his ordinary use of how the building was used prior. So he's adapted that building. He's made changes and converted it. So the costs paid to convert it are going to be capitalized. And that's the paint as well, not just painting one wall inside, but he actually changed the business building to a new business. So it's adapted. And then the third item in that is the R, the restoration. So we want to capitalize any amounts that are used to restore or prolong the life of that asset. So restoration can include the damage or repair of any items, especially for a casualty loss scenario. They have made it more efficient after it started to deteriorate. Perhaps they changed some widgets or they changed the engine, and that they have made it last longer. They rebuild it to new like condition after it ends. So say, for example, again, a truck that has used up its life, but instead of abandoning the truck or selling the truck for scrap, they actually change the engine and increase the value of that vehicle and increase its usefulness. So now it's like a new condition. So they replace parts, they've combined parts for a major component, something large, not just something small, and that's actually restored it to better condition and still usable condition. So here's an example. Barb owns an office building with an adjusted basis of $500,000. The storm damages the office building. She deducts a casualty loss of $50,000 and reduces the basis. So she bought it for $500,000. She had a loss of $50,000. She reduces it. A contractor repairs the damage. She has to treat that $50,000 as paid to the contractor as a restoration of the building. And she must capitalize the cost of it because she adjusted the basis prior to that. All right, so prior to making the repair, she reduced her basis to $450,000. Now, if she received insurance proceeds, then that would be different. She would not be able to deduct the casualty lost, but she would still reduce property value. Which means that she would take this $50,000, pay it to the contractor, capitalize the cost because she had made the adjustment. So again, you just want to make sure that if there's been any damage, did they receive any kind of payment or reimbursement from their insurance? And so they cannot deduct the casualty loss. So making sure that they don't double dip, if you will, unfortunately. But just understand what happened, whether they restored it or they improved it, they made it better. And how that changes the asset's usefulness. All right, materials and supplies. This is something quickly to talk about in regards to whether or not the costs are deductible when they're used or consumed, whether the materials and supplies carried on hand are not for consumption or inventory, whether it's not kept. And then rotable and temporary spare parts are deductible as they're used or consumed in the tax year. And inventories can be treated as non-incidental supplies. Again, we're looking for that magic number of 31 million for the small business exception. So unless it's less than 31 million, they can be treated that way. All right, now listed property, we've heard that term in the past. That typically happens when something might have a possibility of being used as personal and as business. So this is reported and stated separately on a 4562, and the IRS does watch for misuse of some of these items. So make sure that your clients have good records or that you're able to determine what's personal use and what's business use. So passenger vehicles under 6,000 pounds, transportation property, if it could be used for personal use, property used for purposes of entertainment, recreation, or amusement, or other property that's specified under those regulations. So listed property is a specific class, and it's subject to that special tax rule set. And again, you're using it mostly for business, but it does have a position of being able to use for personal use. So we're looking for more than 50%. And then the rest of the time it might be used for personal reasons. So we've got to make sure that we know that amount that's being used for either. So we've got listed property depreciation that is going to be limited to the annual dollar amount applied by the percentage of business use. If it's under 50%, then you're going to use straight line depreciation, and you're not going to do any section 179 expense on that. So you'll fill that out on a form 4562 part 5 to report that. Again, if your client is coming from another tax practice from before, make sure that you have a list of what items are listed property so that you can continue the right depreciation and make sure it's being done properly. So here's an example for you. Jane purchased a digital camera for $2,500 in July. The business use for that camera is 35%. Because she uses it less than 50%, she must depreciate the camera using the straight line over the alternative depreciation system, which is 10 years. And she's using a half-year convention. So we talked about those previously. So here's an example of her part 5 on form 4562. We'll see the camera listed, the date, the percentage used for business, the cost, and then we're going to report what she uses as far as straight line, and then the dollar amount that she's receiving based on that. So your computer system or software is going to fill this out for you, but you want to make sure that you preview it to make sure that it's filled out properly. All right. So again, this is form 4562 part 5 to fill out her item. And now we're going to talk about vehicles. Vehicles we see definitely in the course of business are used to transport clients, transport materials, to purchase items, maybe to go to sales or to the different locations. But regardless of that, our passenger vehicles and light trucks and vans that are under 6,000 pounds are going to be limited to this amount for depreciation. The first year is 12,200, second year is 19,600, and the third year is 11,800. Each succeeding year is 7,060 until the item is depreciated. But you're going to reduce this amount by any personal use of the vehicle. So 100% business use, they would take the full 12,200. If they did anything less than 100%, they're going to take a percentage, and it's going to be reduced by that personal amount. So have your clients keep records. This is oftentimes the hardest part. So here's an example of that. If Helen purchased and placed in service a new vehicle for $70,000 and she drove it for 12,000 miles, 9,000 of that was for business. So her business use is 75%. Pretty straightforward. 9,000 divided by 12. She elects out of bonus depreciation. So her first year depreciation deduction is going to be limited to 9,150, which is that total limit of 12,200 times 75%. So 9,150. So if it was 100% use, then she would take the full amount. If she wanted to do bonus depreciation, then it could be higher as well. But this is straight 1 year, first year. All right, lease vehicles are a little bit different. Lease vehicles that are over 30 days, you might have to reduce the lease expense by the inclusion amount. So the inclusion amount is based on a fair market value on the first day of the lease. Generally not a huge amount, it's a pretty small amount, but we do have to make sure that it is included there. It does not apply when they're using the standard mileage. So if the lease term begins in 2025, then you may have some add back or have to include a certain amount when the vehicle is over $62,000. This is going to be under Pub 463 and also under Rev Prop 2516 Table 3. So you're going to use the table to find the amount for the inclusion. You're going to prorate it for the days of the lease during the year, and then you're going to apply the business percentage. Here's an example of that. On January 17th, you might see that Diane has leased a vehicle for 3 years for use in her business. The fair market value of the vehicle was $86,000 the first day of the lease term. So that is higher than that $62,200, excuse me. So she's used the car for 75% for business and 25% for personal purpose. So her lease exclusion amount is $120, which is taken from the table, $167 times the 349 days over the total amount of 365 for the year, right? Because she started it on January 17th, so we can't include those days. And then 75% of her business use. So she must reduce her lease payment deduction by $120. So not a large amount, but we need to make sure we do that calculation. Here's an example of the table itself. You'll see there the 62,000 to 64,000, the range, all the way down there to 85,000 and 90,000. So 167 is that value that we took from there and then reduced. All right, there's a couple more examples in the book for you as well. But moving right along, we're going to cover any recapture scenarios. So any listed property that was used for more than 50% at one point in time for the business, but then falls below 50%, we may have to recapture the prior excess depreciation. And this is required under the Section 280F recapture rule. So the recapture is considered income on the form it was originally deducted. It increases the basis by the recapture amount, and it's reported on Form 4797, Part 4. All right, and a little bit more into that, so I can give you an example as well, is that it is considered the excess accumulated depreciation, including Section 179 for the years before the business use drops below 50%, over any depreciation that would have been allowed for those years that it was not used predominantly for business. So you're going to use a straight line and you're going to use ADS to calculate that. And here's an example for you. In June, year 1, John purchased a pickup truck and placed it in service. He used the truck exclusively for business. The truck cost is $28,000. He elects to expense $10,000 under Section 179, which this can be a great planning tool also for our clients, is expensing some of the cost, but not all of it. He depreciated the remaining $18,000 of cost or basis using the 200 dB method over 5 years, which is the class life under the GDS. In year 5, however, he used the truck 50% for business and 50% for personal use. So he's going to have an excess depreciation calculation. So here's what that looks like for you. You'll see that the actual cost was $28,000. He did a Section 179 for 10, leaving that $18,000 basis. Year 1, he takes a 20%. That's $3,600. Under GDS, if he did ADS, it would be $2,800. And we see that until year 4 at $20,074 for GDS. And for the ADS, it's $5,600. So the actual allowed or allowable depreciation in this case, the actual amount was $24,890. And the actual depreciation cost you'll see is listed there as well. But we need to recapture the difference between what would be the ADS and the GDS, and that's $5,290. Okay, that's the difference between the two, because the service use dropped below 50% for that time period. So here's the example of that. The difference between that is $40,018, and this is again reported on 4797, Part 4. And the difference is recaptured, and it's shown as other income that he has to list. So if you're looking at journal entries there, you'll see the debit for the accumulated depreciation, and then you'll see a credit for the recapture amount. So make sure that those journal entries are balanced again. All right, so Section 179, expensing election, we just mentioned that. That's choosing to expense a portion or all of the qualifying property that we've placed in service. You're going to look at the lower taxable income and self-employment income if they're self-employed. And in essence, what this means is that you're not going to have depreciation for the asset in the future. So you're foregoing that future depreciation by taking the cost up front. This can be a very powerful tool for your clients, as we mentioned before. You want to see what their income looks like. and whether or not they need to expense the full amount that first year, hold some of it off for future years where they may have higher income. This will help to offset their tax. So talk to your client, perhaps use this again to help them reduce taxes now, but perhaps keep some for the future as well. So, all right, any questions on that? We have some more in the book for you, but in general, we're going to look to revoke the election on the timely filed return. Otherwise, you'll need to do the IRS consent. If you have multiple assets, you can allocate it any way that the taxpayer wants, as long as you don't exceed any limits. You're going to look at Form 4562, and then you're going to apply that at the entity level and shareholder level or partner level when we get to those. So we'll talk about those in the second day. But regardless, determine whether or not your client can expense these items or whether they want to depreciate the items or a combination of both. So qualifying property for that is going to be business use, has to be purchased, can't be accepted property, and the estates and trusts are not eligible for that. So again, not all properties eligible for Section 179. Other things to consider: tangible personal property, whether it's an integral part of manufacturing or production, whether it's a research facility, and whether or not that facility is used in connection with any of the above items for any kind of storage, and if it's a single purpose agricultural, like livestock or horticultural structure. So those are all different types of eligible property that might be able to use for that. They could also be storage facilities, as long as they're not the buildings and the structural components themselves used to distribute petroleum or other primary products. We talked about natural minerals being depleted, so there are some special rules there for that. Any off-the-shelf computer software, that's going to be the software you purchase just right at the store, not anything that's custom made for your business. So, and qualified real property as well. Tangible personal property, you're going to look at machines and equipment, gas station storage tanks and pumps. You might have livestock, so you'll see this with our farmers. They may have horse, cattle, or hogs. You might have portable air conditioners or heaters after 2015. And then property used in conjunction with furnishing lodging as well would be considered tangible personal property. Other items to consider are land and land improvements. These are not qualifying property, but it may also include buildings, swimming pools, paved parkways, docks, bridges, or fences. And then single purpose agricultural structures. I know this is a lot, but it's all in your book for you. And single purpose agricultural structures that are used for housing or raising or feeding particular livestock, including any replacements. They might also have greenhouse specifically designed or constructed and used for commercial production of plants, or structurally and specifically designed, constructed, and used for commercial production of mushrooms. So those would be single purpose agricultural structures. Qualified real property that we're going to look at as well is improvement property with a 15-year life, improvement to the interior portion of a non-residential building, or after the date the building was placed in service. Certain structural components like non-residential real property, roofs, HVACs, fire protection and alarm systems or security systems. Qualified improvements do not include building enlargements, elevators or escalators, or internal structural framework. So you may have to take out some walls or perhaps change or secure some walls inside the building, and those would not be allowable under this option. SUVs, we mentioned earlier, about under 6,000 pounds, that's subject to the Section 280F limits. Or if they're over 6,000 pounds, they're not subject to Section 280F, and 179 is up to 31,300. That amount is allowed if they're over 6,000 pounds. All right, and here's an example of that, specifically for SUVs. In this particular case, Larry placed an Expedition into service. He purchased it for $55,000. He used the vehicle solely for his business, so he can deduct $31,300 of the vehicle's cost under Section 179 and then depreciate the remaining amount. Off-the-shelf computer software, we talked about that just recently. This could be like QuickBooks, Peachtree, TurboTax, any of those that you might find in the store, not anything that's been substantially modified for you or custom made for you. So this qualifies for Section 179. can be purchased by anyone, non-exclusive licensing, and it's not been modified, as I said. All right, and then other accepted property to consider is property leased to others, property that's used outside of the United States, if it's used by governmental units or tax exempt organizations, or perhaps used by foreign persons or entities. And it's except property that's used with a lease, excuse me, under a term of less than 6 months. So, and then other items acquired for business use, they're used as investment and rental real property, then they do not qualify. Personal and business mixed use property can only be used if it's over 50%. Right, so there's that magic number we need to look at. What is that percentage of personal and business use that our clients have to consider? Here's an example for you. Bill bought a wood splitter. He used 80% of the time for cutting firewood, and he sells it to his customers, and 20% of the time he uses it personally. And the maximum amount he can write off under section 179 is $13.20. So that's 80% use of the cost for that. That personal amount is not deductible. Acquired by purchase only, that's pretty clear, but it's not considered purchased if it's from another property. So let's say you have one company and a sister company, and you're selling items in between you. If it's a gift or inheritance, or if you get the property from a related person. So your sister or brother sells you the property or gives you the property, you cannot deduct it. All right, and here's an example of that. So Rick bought 2 industrial sewing machines from his mother at fair market value. They do not qualify because Rick and his mother are related persons. So in this case, it would not work. All right, and here's some income limits for that. 2 limitations to watch out for are the dollar limit and the business income limitation. So here's the phase out limits for 2025 and 2024. Maximum overall for section 179 is property under 1,250,000. Maximum section 179 for an SUV with a vehicle weight over 6,000 pounds, but less than 14,000 pounds is 31,300. And then phase out begins when the property exceeds 3,130,000. All right, and other limits to look at is it's limited to the taxable income from the business. The net income or loss from a business is any and all of the business's income for the year. So wages that were received as an employee, including spouse's wages if married, section 1231 gains or losses, interest from working capital of the business. And then the limitations do not consider section 179, self-employment tax induction, net operating loss carryovers or carrybacks and forwards, unreimbursed employee business expenses, which those are not allowed at this point in time. So carryovers to consider is that it's carried over indefinitely. You're going to report that on form 4562 part 1 line 13. Prior year carryovers are line 10. And if multiple years are carried forward, then you're going to use the earliest year first. And if the asset is disposed of before the section 179 carry forward is used, then add unused amounts to the basis. And here's a note also that you cannot deduct remaining amount in the year of disposition. All right, so amending or revoking that section 179 can be done on any timely filed amended return. You're going to show any changes on the amended return, and you're going to amend to make the following changes: expensing previously capitalized assets, substitute a different asset for the one originally used, increase or decrease deductions, or revoke the elections. And so this is where it's important that before getting to that point, even though we can make that change or revoke that change in an amended return, we want to have those conversations with our clients beforehand so that we can properly report those items to the best of the ability so that we can avoid this happening. But in some cases, that's not the case. So we want to do the best with what we have and what our client provides for us. So section 179 recapture happens if the use drops below 50%. So might not ever be an issue if it's used 100% of the time, but unfortunately, if it drops below, then we'll have to recapture the entire time that the asset's in service. We have to depreciate as if it was never under section 179. We have to report that on part 4 of form 4797 and increase the basis by the recapture amount. And here's a little formula for you. The recapture equals the section 179 depreciation that's been claimed minus the allowable makers that was placed in service to the year of recapture. All right, so there's a great example in the book for you on this, but again, remember those journal entries that we talked about earlier today. If you're going to increase the basis, then the journal entries are going to have a debit with accumulated depreciation and a credit for depreciation expense. All right. So that wraps up income and expenses for us. Now our last section for the day is going to be on entity selection. So we're going to take a break right now. We're moving right along. So let's take a 10-minute break and come back at 15 after, and we'll get started on bonus depreciation. All right, welcome back. We're going to start off with bonus depreciation so we can finish up our discussion of depreciation in general. So for bonus depreciation, it's 40% for the year 2025, which is the additional first year. It will phase out in 2027 unless that changes with any incoming tax laws, but it's deductible for both regular tax and AMT. The $8,000 cap applies to vehicles that are subject to that Section 280F through 2026. It can be used on new and used or new to you property, and the rates will vary over the years. So there is a chart in the book that covers this for you, but in general, understand that bonus depreciation varies by year. Some years it's 50%, some years it was 100%, but currently it's 40% for the year 2025, and we'll keep an eye on that as the year goes. So eligible property is going to be qualifying property that's maybe not used at any time, or that is not used by the taxpayer at any time before acquisition. And the assets are acquired and placed in service before January 1 of 2027. In January 1, 2028, for certain aircraft and long production period property, we may not have that. But if you do have that, then it is considered eligible property. Other qualifying property to consider is tangible makers property with less than a 20-year recovery period, which includes water utility properties, computer software, qualified film. So planted or grafted plants where the election to apply Section 168A5 was made, qualified reuse and recycling property, qualified second generation biofuel plant property, certain plants bearing fruits and nuts, and then as we mentioned, the aircraft as well. So that's all qualifying for bonus depreciation. What does not qualify, however, is going to be property placed in service and disposed of in the same year. That makes sense. Property depreciable after, or I should say under the ADS system. If it's public utility property, floor plan financing property, we talked about this briefly, property received by gift or inheritance, but we wanted to mention that because again, if you received it by gift, it means you didn't pay for it, so there's nothing for you to depreciate as far as cost. It's properly converted from business use to personal use in the acquisition year, so meaning you were using it for the business and now it's being used personally, which means then you're not going to be able to depreciate the cost. All right, so acquisition requirements, you're going to look at the original use test and the acquisition test. So those two specific tests really look at the commencement of when the item was placed into service. Doesn't necessarily mean that it has to be brand new. At one point that was the case. However, we're looking now for it to be a new to the taxpayer, meaning they didn't use it in the past and they are now placing it into service. So could be new, but definitely new to you also exists as well. There's more information in the book on clarification of converting properties from personal use to business use. That might clear up some of those things for you. So acquisition test is the second piece that you're looking for, that you have not used the property at any time before the acquisition, that you've not acquired the property from a related party, meaning your mom didn't give you those sewing machines like our last example. The property's basis is determined by reference to other properties, such as a like-kind exchange, and the substitute basis portion does not qualify for bonus depreciation in that case. The property must be acquired by the taxpayer after December 31, 2007 and before January 1, 2027. All right, and as mentioned before, it can't be gift or like-kind exchange property for this basis. All right, so claiming bonus depreciation. Basically taking the depreciable basis times 40% for 2025, and that basis is reduced for Section 179 amount that you might take, a deduction of any removal of barriers for the disabled and elderly and disabled access credits. So if you're getting any excess credits to this item, then you cannot include that in your depreciable basis. Excuse me, I'm sorry, after talking all these hours. Enhanced oil and recovery credit, credits for employer provided childcare facilities and services. So anything that basically is giving you a credit or value that you're being able to use against your tax amount or tax liability is not going to be used for claiming this bonus depreciation because you're reducing your basis. Form 4562 part 2 line 14 is where we're going to see that, and here's an example of that. April 1, Ted purchased qualifying property that cost $450,000. He claimed section 179 for $250,000, and so now he has a remaining amount of $200,000. That remaining amount can be used to claim $80,000 for a claim to bonus depreciation, and the remaining $120,000 is then depreciated normally under makers. All right, so he bought something for $450,000, claimed $250,000 for section 179. He expensed that. The remaining amount, he took $80,000 for a bonus depreciation, and now the remaining $120,000 is depreciated normally under makers. All right, so you can elect out a bonus depreciation, and this has to be done in order for you to determine whether or not they're going to get that extra bonus. So it's automatic, but if you have to elect out of all of the property in the class that's placed in service during that year. So you've got to attach a statement saying that you want to elect out of the bonus because it's automatically done for qualifying property, but the election can be made also on an amended return within 6 months of the unextended due date. So and that's filed pursuant to section 301.9100-2. So if the property is qualifying, that means that it's going to get bonus depreciation unless our taxpayer decides not to do it. And again, we may do this if the client wants to keep some of that depreciation for future years where he may have higher income, or perhaps they're operating with a net operating loss this year and really don't want to use that depreciation to lower the income anymore. In this case, watch your software as well to make sure that you've done that election correctly. Preview anything that you provide to your client first to make sure whether or not that bonus depreciation has been calculated or has not been calculated. All right. And alternative minimum tax, you want to look at depreciation for the property that's placed in service between 98, after 98, excuse me, using 200 dB. Section 1250 property that's placed in service after 1998 is not depreciated using straight line for regular tax. So these are some specifics for alternative minimum tax, and there's more details in the book for you. This is not something we see very often, but again, the property is going to use these rules to do that. And there's a table in the book that summarizes that depreciation for you even more. So section 4562, form 4562, we talked about that briefly already. We're going to use that to claim the deduction for depreciation and amortization. We're going to make a section 179 election to expense certain assets. We're going to use that for depreciable assets placed in service during the year. We're going to use it every year for listed property and every year for C corporations. All right. So use 4562 in all those cases. And here's an example for you. If you haven't noticed in our book, we're using 2024 forms and rates. The bonus depreciation at that time was 60%. For 2025, it's 40%. So be aware of that. So on January 1, Peter started a small sawmill business, say that 10 times. And the lumber making the machines that he's going to use cost $1 million, but he wants to elect out a bonus and use 100% section 179, and he can. He has a circular saw for $25,000. He's going to elect out a bonus and use regular makers for that. He has computer equipment for $15,000. He elected that bonus depreciation. Again, remember, this is 2024 rate at 60%. The company vehicle was $45,100. It's listed property subject to luxury vehicle limitations. So he's got $20,400, which is the 2024 amount. So bonus elected. So remember that $12,200 that we saw. The startup costs are $25,000. We're going to amortize those with no expensing, and he has a building that he purchased, excluding the land, for $500,000. All right. So those are all the purchases he made for the year. On our 4562, we also need to look at the 7-year property or the class life for that lumber making machine and the circular saw. He wants to elect out a bonus for all 7-year property. The computer is a 5-year property, and so he will take a bonus on that. And then his net income, business income, is $836,476, and it does limit the section 179 deduction. And now we're going to look at his form 4562 for that. So if you look at this form, you'll see that in section 1 or part 1, it lists his income amount, the maximum amount he can take, the total cost of the equipment is there. So we're also going to look at the machine itself for $1 million listed, Part 2 looks at any special depreciation that we have. And then part 3 looks at the depreciation for makers. And then we continue on to show the different information on each single property there and the class lives. So we're going to report everything that he's told us he wants to do. He's electing out of some bonus depreciation for some, he's taking it for others, he's expensing some of the items, and then he's going to depreciate the others. Second form is there for you listed as well. And you'll just see it continues on to give us the amount of what depreciation he's going to take for the year. All right, so review questions are coming up next in pages 100 to 102. We're not going to go through those because of time right now. We're going to go right into entity selection. But if you have any questions, feel free to let us know. But in general, we're going to look at how do we use that depreciation for our clients. We've looked at their books, we've looked at the income they've made, we've looked at the expenses, and now we've looked at their assets and how they're going to depreciate or take the expense for those, the cost for those on their tax return. All right, so now last but not least, we want to determine what entity our clients are going to use. And this is based on what is best for them. So there's no single choice that's better than others, but we want to look at what's available to them and what works for their accounting methods and for the type of business that they have. So single owners will have all but partnerships. Multiple owners can have any entity except for disregarded entities. And these are the typical items that we're going to see. All right. So one thing again to remember is we're going to choose what's best for the taxpayer. So they may have a limited liability company that helps to protect their personal assets. We may have a partnership where it's 2 or more people there. We might have an S Corp or we might have a C Corp. And we're going to talk about each one of those here as we finish the rest of our class for today. But take, for example, a client that has a single member limited liability company. They're typically taxed as a Schedule C taxpayer. We see this a lot. They have a personal tax return, they've got a small business on the side, and they're running it through their personal tax return under a Schedule C. But they get some advice from their friend who's an attorney, and they determine to change their status to an S Corp. And they give him a wage now, like we give our taxpayer a wage. So that W-2 wage now takes him into a different type of tax return because we've got to now file a business return for him. And that can be difficult if our taxpayer doesn't understand what each one of those companies or which each one of those entities then become. So we've got to now take him from being a Schedule C taxpayer to a W-2 taxpayer on their personal return and then file a business return for them. So do what's right for the taxpayer, have that conversation with them about whether they need to do an S Corp or C Corp or partnership. LLCs, very common option, but that's not something that the IRS recognizes, meaning that there's not a tax return for an LLC. So they're going to have a hybrid legal structure where they've got their assets protected. That's why they chose to be an LLC. The owners are now called members, but you might have a single member LLC or you might have a multiple owner member type of LLC. So a single owner or single member is what we see a lot. They've got a small business, they're the only one that runs it, or perhaps them and their spouse. And so we're going to make them a SM LLC or an MLC. The default rules on these, typically, here's some information for you there. And the book goes into this a little bit more for you, but an SM LLC or single member is going to have a Schedule C. We see those all the time, but then they're going to elect to be treated as an S or C Corp. They're never a partnership. We are going to see forms 2553 and form 8832. We're going to do examples of all of these on the 3rd day. We have a really great case study for you. And the multi-member LLCs are going to be a partnership. They're going to have a form 1065, so not a Schedule C for them. They're going to elect S or C Corp, and then they're never going to be a disregarded entity. And again, a 2553 or an 8832 for these. All right, and for partnerships, we're going to look at the relationship of what we have going on between the owners. So they want to carry on a business. There's going to be 2 or more individuals. There might be 2 or more partnerships, or there might be 2 or more corporations. They're going to all contribute money, property, labor, or skill. So you may have one partner that puts in money to start the business, one partner that provides cash. Instead of cash, they provide land, or that provides the skill set. So ideally, we want to look at what that relationship is, what they contribute, and how are they sharing their profits and losses in the partnership. So the partnership itself is a legal entity that basically passes through the income and expenses to its partners through that K-1, right? So they don't pay tax. They use a Form 1065 to provide that information and activity, again, passing it on to each one of the partners. All right, and S Corps, you're going to see domestic corporations that might elect to become an S Corp. Again, it's a separate legal pass-through entity. It's taxed on built-in capital gains or excess, and it's a limited liability protection of the C Corp. They're going to use a Form 1120S instead of the 1065 that we saw for partnerships. This is what they're going to provide to the IRS to show their tax return. So you might also see on C Corps, they're going to see a Form 1120 as well. C Corps do pay tax. It's not a pass-through entity, and it is also a separate legal entity. The shareholders pay tax on dividends. So we might see some double taxation there. The book goes into that, but we're going to talk about that in some of the examples we have. And the losses remain for the corporation to use against their income. So when it comes time to choose that entity and to determine what works best, we're going to look at LLCs. Again, they're just an entity of choice. It's not recognized by the IRS, and there are no separate forms or tax forms that are going to be completed with an LLC. It's just a default option that they might choose for legal protection against their own personal assets. And that might be why many of our clients who are small business owners choose an LLC. And that's fine, they'll be taxed the same way. But if it's a single member, again, remember they're going to be a default disregarded entity because it's not a tax structure. They're going to elect to be an S or a C, but never a partnership. Again, because it's one owner. Partnership requires two. The multi-member LLCs are in essence a default partnership. You'll need to elect S or C, how to be treated for a tax return basis, so that you can determine whether you're going to use an 1120 or a 1065. The pass-through entities that we see are going to be the partnerships and the S Corps. We talked about passing those through to the K-1 structures. And for the C Corps, that's different. So rules of thumb to remember, your partners are going to pay self-employment taxes on their ordinary income and guaranteed payments, but the property comes out at a partnership basis. All right. So meaning that they have to pay their taxes on any income that they receive or any guaranteed payments. And that's part of the structure of the partnership, meaning there may be some agreement that they're going to be paid back a certain amount, or that they're going to be paid a certain amount every year. And that's a guaranteed payment for them no matter what. So that property comes out at the partnership basis, and then they pay that with their normal personal tax return. An S Corp shareholder will need to take a reasonable wage. And we talked about reasonable compensation at the very beginning of the day and how you may have to help your client do that. This is where we'll see that. Reasonable compensation, it could be vary. It could say that he's only taking $20,000 a year as an employee of the S Corp. But really, when you do a market comparison, the rate of wages should be closer to 50,000. So taking a reasonable compensation or a reasonable wage is part of what you're going to help your client determine if they haven't already done that. So they need to take that, but they don't pay any self-employment taxes on those wages. They get paid in a W-2 that is provided to their personal tax return. So they will pay their half of self-employment taxes, and then the other half is paid by the corporation. If they're not a W-2 employee, then we see what happens with the partnership. So at any rate, the property that's distributed from an S Corp is going to be taxed as a deemed sale at fair market value. The book talks about these different nuances with each one of the partnerships and corporations that we're looking at the different entity structures. You'll get more information over the next 2 sessions on how those all work, especially on the tax returns, because we're going to prepare one of each. So for our C Corps, there is a section of double taxation that occurs because the shareholders are both employees of the company as well as shareholders, so they may have some dividends. They've got to take that reasonable compensation. They're going to have a flat tax rate of 21%. And then the property that's distributed is also going to be considered a deemed sale at fair market value. So, and corporations do not get any special capital gains tax rates. So that is going to be something that that they'll have to look in when they determine what to do when they make that election to either be an S corp or a C corp, or stay as a partnership. So talk to your clients about what they want to do. That first year is important. They have to make that election to be treated as a certain type of entity. And there's a form that they will file for that. So we'll give you examples of that moving forward. But in summary, those are the entities that we want to look at over the next couple of days, is understanding when someone is a partnership, when someone is an S corp, when someone is a C corp, when we need to issue a Schedule K-1, when they may have a W-2, and then actually determining what's the best option for our clients, whether they use a partnership, an S corp, or a C corp, and what's going to happen with their taxes. All right, so in the next class, please read over the partnership and S corp sections of the text. Do the case studies if you have some time, but we will certainly go over the case studies as we go through each section and in the class time, the last class time as well. So thank you very much for coming today, and we look forward to seeing you soon.